Hello, everybody. Welcome back to another market close. Today, we have Microsoft, we have Google, we have Snapchat, we have Roku, we have Teladoc, we have Capital One, we have T-Mobile. There's a string of companies we're looking at today. Obviously, the three big ones are Microsoft, Google, and Snapchat, and the really two big ones are Microsoft and Google. That's why Sundar Pichai and Satya Nadella, CEOs of Microsoft and Google, are on the thumbnail. This is going to be a pretty big earnings day. We're going to go through estimates. We're going to go through what we're looking for. Snapchat right now up 4% as we get into the close. It was down 5% in the morning, so very interesting kind of the dynamics going on there. Talk about Meta. Meta continues to bounce up. When we left the market open at around 10:30, Meta was actually recovering a bit from 15% down, ended up recovering a little bit more. And then Tesla adds $71 billion in market cap to their company. Tesla right now, $169. Absolutely incredible stuff going on in the world of Tesla. So thank you, everybody, for being here. It is time to get into a pretty big day when it comes to the market close and for earnings season. Let's get into it. Captain Edward, Pitt, Astrocus, Steady Oxen, Low Watt, I'm Beneficial. Tesla YOLO is trying so hard to stay in the game. Yeah, my Tesla calls are like, they're trying. They're like begging for 175. Maybe we get a profit. Right now, they're still down because the theta decay is just eating at them. But we'll see. John Younger, Wealth Basic, AI Money, Jay Roberts. What's up? What's up? Thank you all for being here today. It means the world. Someone actually commented on the previous market open and they said, hey, Amit, I watch you every day. You're like a drug. And I had eye surgery today and I was listening to you while I was having the surgery. And I was like, dude, that's fucking crazy, dude. That's gnarly, dude. That's fucking amazing. I love it. Thank you all for being here. It's time to start. Low Watt says, I think Amit is Elon in disguise. I am not Elon in disguise, but what I will be getting in a couple of days as we get started on the market open is one share of Elon Musk's company. In about 2 days, I will be getting a physical stock certificate of Tesla. And I will become a Tesla shareholder for life because I had a bet with a friend of the channel, Derek, on if Tesla went up, he buys me a share. If Tesla goes down after earnings, I buy him a share. And so I am going to be getting a framed share certificate of Tesla. It's going to be really fun. It's going to be exciting to just hang that up in front of my wall forever as a Tesla shareholder. So going to be really cool to see how that happens. Where can we get those certificates? A lot of websites do it, but giveashare.com is the easy one. And so a lot of them do it. Joel says, I wouldn't listen to you while getting eye surgery. Sorry, dude. You're hurting my feelings, Joel. Come on, man. That's not nice. All right. So let's talk about the preview. What are we looking at? We are looking at three big companies in a few minutes, about 12 minutes, that are going to report their earnings. These are the big ones, and then we'll go through the small ones. We'll also talk about Palantir today. Palantir had a really exciting day. Microsoft. The street wants $2.82 of EPS and revenue of $60.8 billion. That's what we're looking for Microsoft. So those are the numbers that we have to beat. Google, 151 of EPS, revenue of 78.59 billion, which I believe quarter for quarter is up like 6 or 7%, and year over year is up about 15%. So that'll be interesting as well to see how that one turns out. And then Snapchat, the street is expecting them to lose 5 cents a share. So if Snapchat maybe doesn't lose 5 cents a share, that'll be a beat. And then revenue of 1.12 billion. And so we'll talk more about all three in a second, but those are kind of the three numbers that we're looking at as we get into this one today. So what is the actual preview for these three? Well, before that, let me also show you this. So this is the index, or not the index, but this is like the playlist we have on Webull. So it's going to be April 25th. Here are the 9 companies we're looking at. So as the market closes, this is going to be open on the left-hand side of my screen. These are the main. There are some other companies, but like these are the ones that matter. Teladoc and Roku, those are the Kathy ones we're going to be looking at. Team, that's a software SaaS business. I was like, okay, let's just put that up there. Capital One, financials, that's important to look at. And then Intel, I don't know what the hell is going to happen with Intel, but I do know it's been sold off like crazy. If I had to bet on any company, inching a little bit higher, bouncing a little bit, it would be Intel. Although the guidance for Q1 from Q4 sucked. But I just think that's baked in, dude. I mean, I really do think it's had. I mean, if we just look at the year to date on that one, look at this. I mean, it's been tough, dude. It was at $50 January 26th. It's at $35. So I think Intel hopefully will have some good stuff. 1.62% up right now. T-Mobile, That one we're going to be looking at as well. That one's going to happen today. And then Snapchat's really exciting. It's up 3.4%. It was down 5%. It was at like $10 in the morning. Now it's up 3%. So obviously people are getting bullish that the call is going to go well. We'll see what happens there. And then Google's down 2%, Microsoft's down 2%. So I like that they're down 2% to set up the earnings, because if they beat, there's some room to run, even if they don't run a lot. Google and Microsoft both are up about 10 to 12% year to date. So they've had a good year so far. The question is, how much more momentum do they have in the tank for them to keep going? If you were not part of the market open, GDP projections came out this morning, and the GDP projections were 1.6%, which was lower than the 2.5% that the street wanted, definitely lower than the 3.4% we got last quarter, which means we are not growing, or we're growing, but we're not growing as much as we should be growing as the United States of America. But not only are we not growing as much, inflation increased consumer prices from 3.7 to 3.4% on the price index. So we had increasing inflation, decreasing growth, which means it's begging the question, are we in a period of stagflation? And I don't think we are. I think there's a lot more nuances to stagflation. People are comparing it to the 70s. It's a little too extreme. However, productivity levels are the highest they've been since 2007. If we can't reduce spending or inflation, then productivity, aka AI, is going to have to be a tailwind on productivity, increasing operating incomes, revenue, decreasing costs, ultimately helping earnings. I don't know. The IMF put out that report the other day that like AI is going to be a big tailwind for the United States, but our debt to GDP ratio might just overtake what AI gives us. So we are living through one of the most amazing technological revolutions of all time with AI. But if we can't stop spending like drunken sailors, I mean, is Michael Saylor going to be the one to save us instead of AI, given his Bitcoin thesis ends up playing out, right? We're going to see what happens there. But that was some of the news that happened this morning that also shocked the markets. And that's why things went down as well. Sir, thanks for the $5 super chat. I bought a Tesla $180 call for May 3rd. Currently sitting at 100% profit, and I can't sell it because Hood will flag me as a pattern day trader. Oh my gosh, that is hilarious. Hey man, take the flag for today. Take a little bit of a flag. You're not going to make that much money on it though, right? Tesla 180 call, you're making like $50. Yeah, it's probably not worth it. That is good though. I mean, look, the way that Tesla's looking at right now. Let's transition to Tesla. We got 8 minutes until this opens. Tesla right now is just phenomenal. 169.68. I think we can maybe touch that 170. Did we hit 170 at all? No, we still didn't hit 170. My Tesla calls, unfortunately, I had the 185 strike. If I had 180, they'd probably be up right now. They are the 185s are. I'm still down 50%. In the morning, I was down 80%. So if Tesla somehow goes to 175 by tomorrow, maybe I inch a profit, like maybe. Probably not going to happen, but the fact that it's even at 170 is absolutely absolutely phenomenal. Tesla added $71 billion in market cap. They lost $71 billion last week. ExxonMobil had a higher market cap than Tesla. Tesla right now, 540. If you look at XOM, they were back at 479. Tesla was at 465 last week. So really exciting to see this. Obviously, Ron Barron on CNBC this morning also called the bottom. We don't know if that will be the bottom, but Ron Barron says that's the bottom. Ron Barron put in $400 million in 2016 after Tesla had already 7x'd, but he saw the vision. That was before Tesla was going to go on to 25x, and that is now worth $4 billion. It was $5 billion. So, I mean, everyone who's thinking they're sitting on losses of Tesla, think of Ron Barron, $1 billion because it got wiped away, right, since the beginning of the year. But he believes that this was the bottom because the street cared about the M2 and the robotaxi, like the M2 being scrapped for the robotaxi. That's not happening. And if that's not happening, then hopefully Tesla is going to be in a good position. Okay, let's do a poll. Let's do a poll in the chat. Let's do a poll. So we have 7 minutes until the market closes. I'm going to disclose my thoughts on all 3 of these main companies that we have right now: Snapchat, Microsoft, and Google. And then we'll go from there. So the poll is going to be, we're just going to do, okay, let's do this one. Which one outperforms after hours? Microsoft or Google? Basically, which one goes up more than the other? So it's kind of you have to make a bet which one does worse than the other. I did a Twitter poll on this. This has I don't know why YouTube doesn't let you get more options, but Twitter had 4 options on this. And so let me show you the results on this one. Also, we got to talk about Google and Microsoft in particular. A couple things I want to say. So this was the poll. Does Google go up, Microsoft go down, Microsoft go up, Google go down, or do both go up and both go down? The one that got the highest amount of votes was both go up out of 820 people. So 37.8% of people on this poll believe, the majority of people believe that Google and Microsoft are going to crush their numbers and they're going to do good. Now, here's my preview. I think Snapchat goes down and I think Google and Microsoft go up. I'm probably gonna be wrong on Snapchat because it's oversold, but they fuck up every single time, dude. They royally fuck up every single time. It's it's in their nature to fuck up. So I'll probably be wrong because it's oversold so dramatically, but I think Snapchat's gonna miss their numbers again. How low can it go though? I don't, because last time, remember, it went from 17 to 10. This time it's at 11. Does it go to 7 or 8? I don't think so, right? So I know I'm gonna be wrong on this, but I'm gonna say they're gonna go down. Google, I feel like I'm gonna be wrong as well, because I think if any part of their search business shows a little bit of like weakness, even though we know LLMs are not taking away search traffic entirely yet, but if it shows the signs of weakening, I don't think YouTube's going to be weak, but I think search might be weak. Google will go down. Why do I still think it's going to go up? I think there's two sort of Hail Marys. A, Sundar announces a dividend. That would be crazy. Probably I'm giving it a 5% chance of happening. It's not going to happen, but let's say it does happen. Second of all, their cloud AI business brought in $900 million of profit last quarter. If they can get that to like 980 and show some significant growth, at least in the net income of the cloud business, because it wasn't profitable for like almost 2 years, maybe the street's like, all right, these guys are a player with Azure and AWS, and that's what pumps them up, even if it's a little bit. So I think Google will go up based on that, but probably going to go down. Microsoft, I think, is going to go up just because it's Microsoft, and I think they're crushing it. OpenAI is crushing it. We know they're ahead of everyone when it comes to AI. They could fall simply because they have a bit of a richer valuation. So Microsoft right now on a PE basis, I think, is one of the more expensive ones. Microsoft here, yeah, 36 PE. It's the most expensive outside of NVIDIA. Oh, Tesla's 170. Tesla is 170. What a freaking phenomenal thing to see, dude. By the way, Meet Kevin is back into Tesla, which is so funny because he sold all of it at like, I think he said he sold the majority of it at 165 to 170. So it's back at 170. If he bought it today, he had to buy it at 165 to 168, right? I think he bought it like 2 hours ago. So literally he had to buy it at the same level he sold it at. So we went through all this hoopla of him doing like, oh my God, Tesla. If he bought it at 140, that would have been some baller shit, dude. If he bought it at 140, that would have been some baller shit. If he actually bought the dip at 140, but he got greedy. And he got just a lot of people. I got greedy too. I didn't buy it at 140. I thought it was going to 125, right? He got greedy. But yes, Meet Kevin is back into Tesla. 10%, I believe he bought more of Tesla. Not a huge position, but he did buy some. Let me show you the screenshot for that right here. Where is this thing? It is. Oh, did the person delete it? Wow, interesting. Oh, he might have deleted it. There was a guy who's part of his Discord who posted it publicly. Oh, no. Wait. Well, either way, it's going to come out to the PP fund people who subscribe to the notification. So I should be getting an email soon. But I did see that he was back in. We'll see. I don't know why he deleted the tweet, but he is in. And if he is in, he basically bought at the same price that he sold, which is, it just goes to show you that that's no shade against Kevin. It's just really hard to do this game, dude. It's really hard. Now, if he bought it at 145, that would have been some G shit. That would have been some epic shit because he got a pretty significant discount. But he got greedy just like the rest of us. So here we go. Tesla to 170, up 5% right now. ExxonMobil 121, Microsoft 399. Palantir had a great day. I bought like 30 shares of Palantir today. I mean, I just can't express how bullish I am on the company. There's going to be a video out later today where I talk about their new healthcare partnership. I didn't buy it because of the healthcare partnership. I saw it go. I mean, it went down like 3% today, so I just started buying some more. But that healthcare partnership is another reason I think they're going to crush. I think the company's going to crush. Regardless of what happens to the stock on May 8th, I think they are in a prime position to keep doing what they're doing. And so I did buy some Palantir today. He still got the tax law credit. That is correct. I wonder, though, is the tax loss credit that he got from selling his Tesla like that important in comparison to getting back in right now? So I don't know. We'll see. Probably it was a good thing. But if he got it at 140, forget the tax loss credit. If you got like as many shares as he bought at 140, it still would have been like, really good, even if he didn't get the tax loss credit. So it's hard. It's hard to time this stuff. All right. So we have how many seconds? We have 40 seconds. Oh, NVIDIA today as well had a great day. Look at NVIDIA, dude, up 3.6%. Meta, real quick, Meta as well recovered a little bit. Meta down 10%. It was only down 15%, which means enough people bought up the dip for Meta, which is good. That Meta also got some love, and hopefully that means Microsoft and Google, if they don't do that bad, this earnings will not be the worst for Q1. Okay, folks, so here's what we're going to do. We got 15 seconds. Market's going to close, and then you know the drill. We're going to be anticipating for about 5 minutes until the numbers come out. That's usually how long it takes. And then we will see what happens for the future of the stock market. Ladies and gentlemen, Thursday, April 25th, 4 p.m. Thank you, everybody, for being here. The stock market is now closed. All right, here we go. This is the time where we get to just sit in anticipation and see what ends up happening. So where did we end on the day? Teladoc and Roku also, I think, are important ones. I think Teladoc, it's just been sold off so much. We'll see what happens. Roku, their growth just isn't there, but they've done okay over the past month. We'll see what happens for that. That's going to be impacting obviously ARK. Snapchat is already down 1% after hours. Google's flat and Microsoft's up. Microsoft's up 2.5%. Okay, maybe the Microsoft numbers are in. Maybe they're in. Let's go. Let's see. Microsoft. Pulling it up. I'm pulling it up. Google. Let's see. And then Snapchat. Microsoft numbers. Oh, a dividend. Microsoft. Wait, Microsoft. Damn, I got too excited. Microsoft has always had a dividend. Sorry. It's not a big deal. Sorry. I was like, oh my God, a dividend. No, they've always had a dividend. It says Microsoft announces quarterly dividend. I got so excited. I was like, okay, here we go. It's like 0.5% or some shit. They've always had a dividend. All right, so for false flag on Microsoft. Let's go to Google. No update yet on Microsoft. Google earnings are not out yet. Microsoft's up 5%. Something good happened with Microsoft. Microsoft's up 5%. Teladoc's up 1%. Snapchat is flat. Google's slightly green. Microsoft's up 6%. Holy crap, Microsoft has to be good. Intel's down. Oh, don't tell me Intel's down. Wow, Intel's down 5%. Wow. All right, it's down 2%. It's recovering a little bit. Google's still flat. Microsoft's up. So the Microsoft numbers are out. Google's not out. Google's not out because Google would be moving. On my feed, I see nothing. Let me know if you guys see any numbers. I don't see any here. Snapchat, I don't see anything on Snapchat, and on Twitter, I don't see anything either yet. I don't see anything either yet. And we also have Roku. We'll check on in a second, and then the other ones, T-Mobile, Capital One, all those guys. Google, nothing yet. Microsoft, do we have anything? Microsoft's up 5.2. Oh, Google's up. Google's up 2%. There we go. Google's up. Not bad. Google's up. Microsoft beats. Okay, Microsoft beats. Here we go. We got Microsoft. Here we go. We got Microsoft. Microsoft beats. Microsoft. Google. Wow, Google's up 5%. Let's freaking go. Google's up 5%. Snapchat's up as well. Snapchat's up 1%. Microsoft and Google are both up 6%. Oh my God. Google's at 169. Oh my God. Google's at 7%. They have to do a dividend, dude. Tell me they did a dividend. They have to do a dividend. There's no way this thing is up that much. Without a dividend. Why is Google up so much? Oh my God. All right, I don't have the numbers yet. Microsoft, here's the numbers. Microsoft revenue, $61.9 billion. They beat $60.8 billion expected. Cloud revenue, $26.7 billion. They beat $26.5 billion. And then EPS $2.94. I believe they beat on that as well by, they believe the EPS, they beat on that by 10 cents, 12 cents. Wow. That's a good beat. Oh my God, Google's up 10%. What the fuck is going on? Why is it up? Palantir's pumping as well. Why is it up? Microsoft's up 5%. Snapchat's up 2%. Roku, okay, thank God. Kathy's got something here. Roku's up 7%. Snapchat's still flat. We don't know. Why is Google up 10%? What's going on? What did they say? I'm looking. I see nothing, dude. I see. Oh, I got it. Here we go. All right, you guys ready? You guys ready for Google? Here we go. Azure growth 31% for Microsoft. That's amazing. Azure 31% growth. Google growth, Alphabet, EPS 189 versus 153. They beat by 30 cents. on EPS. Wow. First quarter revenue 80. They did a dividend. 20 cents a share. I had a feeling they did a dividend. Dividends have been declared in the world of Alphabet. It's happening. 10%. There you go. We've been talking about this on the market open for at least 2 months now that Google needs to do a dividend. 170 freaking 5 on Google. This is so good. Even if you don't own Google stock, it doesn't matter. You need Google, you need Microsoft, you need Meta to pump in order for this economy to keep rolling. Is this an artificial pump because of the dividend? Maybe. We'll go deeper into the numbers, but still. What else do they have? On Google? Ads revenue on YouTube, 8.09 billion versus 7.73. That they beat on ads. First quarter revenue, again, 80.5 versus 79. They beat by $1 billion basically on revenue, dude. And then they're buying back another $70 billion of shares. Another $70 billion of shares. Holy shit, dude. Where's Palantir after hours? Oh my God. This is great, dude. Palantir's 22. This is what I'm saying. Even if you don't own Google or Microsoft, it doesn't matter. It doesn't matter. Because the reason Palantir's up right now too after hours, Robinhood's up after hours, Snapchat don't have their numbers yet, but they're up 1.27%. Meta's up 1% after hours. The reason this matters is because Google, Microsoft, Meta, Amazon, Apple, they are the market at the end of the day. They are the market, and we need them to pump, especially with inflation being as sticky as it is. Let's go to CNBC. Let's get their updates on it, and then we'll keep going. We got the fucking divvy, dude. We got the divvy. The divvy is here. Tesla's up. Wow. Tesla's up 172 after hours. Dude, if those calls that I have actually fucking print somehow, if Tesla gets to 175, holy crap, dude. Shout out Google. Shout out Sundar for doing what he needed to do, which is give a mother effing dividend. That's what I'm talking about. All right, so let's get into this. Here we go. Let me pull it up. All right, I'll be back in like 2 minutes. Let's hear what they have to say, then we'll keep going.
I have the numbers. Deirdre Bosa has them for us. Hey, Dee.
Hey, the street is very happy with what they're seeing. Shares are up nearly 12% in the after hours. So let me give you those numbers. It's a beat on both the top and bottom line. Revenue coming in at $8.5 billion, 78.6 billion is what the street was expecting. Another beat on EPS, $1.89 versus $1.51 expected. Google Cloud revenue also beating, coming in at nearly $9.6 billion, 9.35 is what was expected. Looks like a beat on YouTube revenue as well. And I always like to look for the total number of employees, actually a decrease in this quarter from the fourth quarter of last year at 180,000. We'll continue to go through this and bring you more as we get it.
That's a big move. It's like the other end of Meta yesterday. D, thanks, Kevin. I got to go back to you and let you finish.
Yeah.
Go for it.
Yeah, I think everyone can take a deep breath now, John. The tech trade isn't dead just yet.
Yeah.
And if I can go back to Microsoft for a second, I do believe that Microsoft has the balance sheet, they have the expertise, and they have the commitment to be one of the ultimate winners in the AI race. I like what they're doing with Azure from the cloud side. I like what they're doing with their AI-powered Bing Deep Search, and of course, what they're doing with Copilot. But even more interesting to me, John, is their involvement in data centers. Microsoft announced earlier this week that they're going to build $2.9 billion of data centers in Japan by the end of 2025. This following their acquisition of Fungible in July of 23 to actually accelerate data center innovations. Data center at the core of the AI ecosystem. Microsoft gets it. They're going to continue to invest in this area. They have the balance sheet to do it, and I'd expect better days ahead for Microsoft, certainly as it relates to AI.
All right, Nicole.
Okay, guys. This is what we needed, dude. As he said, the tech trade is not done. Google's up 13%. Oh my God, it's going to 180. Oh my God, it's going to 180. It's going to 180. Holy shit. It was going to 180. This was at 130 2 weeks ago. It's going to 180. It's going to, Roku's up 10%. Shout out to Kathy. T-Doc up 4%. Shout out to Kathy. Why is Snapchat still flat? Are the numbers not out for Snapchat? Does anyone have the numbers? I don't see them. I don't see them. For those just joining, Google added a 13% dividend. Let me close the window real quick. There's this guy blowing his leaf blower outside. It's making too much noise. Give me 1 sec. How is he blowing his leaf blower when fucking Google earnings are going? What the fuck is going on with this guy, dude? All right, so Google up 14% now. Microsoft's up 5%. Google just added about $150 billion of market cap after hours. Oh my God, dude. S&P's up. Oh, I forgot it. S&P and QQQ. S&P is at 507. Wow. QQQ is at 429. Meta's probably up on this. Meta's up. Meta's flat. Okay, Meta's flat. Nvidia is up 2%. Look at that. Again, moving 2% on NVIDIA is not easy. Moving 2% on a $2 trillion company is not easy. Moving 14% on a $2 trillion company, which is what Google's doing, is also not easy. Apple is up 0.25, and then Amazon's probably 180, right? Amazon, there you go, 181 on Amazon. Amazon's up 4% just because of Google. This is only because of Google. That's it. This is only because of Google. SoFi 769, and where's Palantir? Oh, dude, it was a great day to buy Palantir today. Look at that, Palantir 22. It was, if you're getting like 2120, 2140, not bad. Now let's see if it can hold, but not bad at all for Palantir. And then SoFi as well. SoFi's pumping. The whole market's pumping. This is what I'm saying. SoFi's up 1%. It doesn't matter if you own Google or Microsoft. So you don't have to be sad. The point is, Google's 180. The point is the whole market's going to pump. This is what we need. Guidance must be good. Okay, let's go to the deck. Let's go to the deck. Let's go. Thank you, Sundar, dude. Sundar finally, he did it, dude. He did it. You know, like Kamala's like, we did it, Joe. Sundar did it. Sundar finally did it. This is what shareholders needed. Now, granted, does that mean that Google's not growing anymore? I don't think so. It's 20 cents a share, dude. The yield is like 0.0 something percent. So I think they literally, we were talking on the show, like if they just give a little sprinkle, a little smidget, 20 cents a share, just like a little something, it could be 10 cents a share, dude. Just give something back to shareholders. Think about Bill Ackman. Bill Ackman owns 4 million shares of Google. By the way, at a 98 average or something, so he's up big right now. He's getting 20 cents for all those 4 million shares. That might not seem like a lot, but to someone like him, an institutional shareholder as well, that's a lot of money. Okay, here we go. Sundar Pichai, CEO. Our results in the first quarter reflect strong performance from search, YouTube, and cloud. We are well underway with our Gemini era, and there's great momentum across the company. Our leadership in AI research and infrastructure and our global product footprint position us well for the next wave of AI innovation. CFO. Our strong financial results for the first quarter reflect revenue strength across the company and ongoing efforts to durably re-engineer our cost base. We delivered revenues of $80.5 billion, up 15% year over year, and operating margin expansion. Snap is up. Snap is up. Snap is up. Holy snap. Let's do this. What do we got? What do we got on Snap? Did Snap somehow do it? Oh my God. Snap's up 20%. What's going on? What's going on with Snap? What's going on? What did these mother effers say, dude? They had to say some nonsense. There's no way. What did they say? They still lost 1.3 billion. How the fuck are they up 20%? This has to like all right, I'm curious. What did they say? What did they say? Again, they got sold off. So this is what we were talking about, that they got sold off. So they probably were going to go up, but still, are they going up for bullshit or are they going up for a real reason? Increased DAUs by 10%, 414 million. Fourth quarter, guys, fourth quarter revenue, 5% year over year. This is not a growing company. These are not, so far, these are bad numbers, but still it was sold off aggressively. So it probably had room to run. And then if Google goes up, the whole market pumps. Revenue was 4.6 billion. Net loss was 1.3 billion. They lost $1 billion. They lost $248 million this year. What did they issue a dividend? What does Snapchat do? Why is Snapchat up? They have 7 million subscribers on Snapchat Plus. I think they had the same amount last quarter. There's no way that grew dramatically. Maybe they had 4 million, so maybe it grew a little bit. Over 300 million Snapchatters engaged with augmented reality. Normally, Snapchat is always down 20%. Yes, normally it is down, but again, I don't think any of us thought this was going to like $6, right? Like we thought it would get a pump. But again, this pump is like the Tesla pump, but Elon Musk is what made the Tesla pump real when he started talking. Evan Spiegel, I don't know if he can make this 25% pump real. I mean, why is it up 25%? Please, someone tell me while you're looking in the results. And don't say the TikTok ban because that's not real yet. So like, what is it? And also those TikTok creators aren't going to Snapchat. They're going to Instagram. You can't really build a brand on Snapchat. You can't even make money on Snapchat, right? That's not really the place. But who did earnings? Who bought some shit before earnings? Who bought some shit? Robinhood's up a little bit right now. Palantir's up 1.4%. Where's Google? Google. Where is she at? Oh my gosh. And then we'll get into the other companies as well. It's up 12%, dude. $177 on Google, dude. $177. Absolutely beautiful. Quandale says I bought 6,000 puts on Google or on Tesla. When do they expire though? If they expire early, then yeah, rest in peace. But if not, oh, this is the fourth quarter results. Hold on, holy shit! Did I read the wrong results? Oh, dude, it's not my fault. It's not my fault. I read the wrong results. Look, this is what I pressed. I pressed this. I pressed this button, Snapchat Q. This is what I pressed, guys. Q1 2024. That's what I pressed. And oh my God, hold on. That's the wrong thing. Look at that. Did you guys see that? I pressed Q1 2024 and I pressed press release. And when I go to the press release, this is the press release, fourth quarter financial results. That's wrong. Okay, so I read the wrong thing, which means I need to get the actual thing. So let me try to find the actual thing. I think this is the actual thing. No, this is the wrong thing as well. Look at this. You see how it says February 2024? This is what I clicked on. I clicked on Q1 2024. So where's the fucking earnings then? Where's the fucking earnings, dude? What the fuck? What's going on here? It's like, but I guess the earnings are better than what I read because Snapchat's up. They have to be better. I don't have the numbers. Let me go to Twitter. Twitter probably has the numbers. They have to be better numbers. There's no way it's up this much. Oh, it's well, I don't know if these are better numbers. So here's the numbers. They beat on revenue. They beat on EPS. They lost a little bit less money than what the street expected. They beat on EBITDA. They beat on DAU. Yeah, but I don't know if that's enough to pump it that much, 25%. I don't know. I mean, look, congrats to Snapchat. It's up 30% right now. All of these are beats from a stock that was low-hanging fruits, but it's not like phenomenal numbers. But regardless, whatever. Snapchat's up 27%. That's amazing. The entire market is pumping right now. Let's go back into Google, Microsoft. Let's go to Microsoft's deck. I didn't pull them, but Microsoft right now is up 5%. Microsoft looks like nothing compared to Google right now. Granted, Google is a smaller company from a market cap perspective. I think $1 trillion less than Microsoft. But let's go to Microsoft's deck and see what they had to say. Okay, Microsoft press release. Here we go. Microsoft. This is what we got on Microsoft, and then we'll go to the other companies. Snapchat raised revenue guidance. Snapchat's up 40%. They're up 29% right now. Revenue guidance, that's good. Revenue guidance is good. We'll talk about Intel in a second. Okay, so revenue was $61 billion and increased 61% year over year for Microsoft. Operating income, $27.6 billion, increased 23%. Net income, $21.9 billion and increased 20%. They are compounding profits 20% year over year. Insanity, dude. Insanity. Okay, so Satya Nadella says Microsoft Copilot and Copilot Stack are orchestrating a new era of AI transformation, driving better business outcomes across every role and industry. This quarter, Microsoft Cloud revenue was $35 billion, up 23% year over year. That's amazing. I think they did 30% growth in cloud, right? Did they do 30% growth in cloud? They bought back $8 billion of shares and dividends. No, cloud is 23% revenue. Cloud is 23% growth. I think AI cloud might be 30%, but cloud Azure overall is 23%. Still good numbers. Great numbers. Great numbers. Claudina says, I own Intel. I should have sold it. Is it even worth it for long? I absolutely think owning Intel for the long term is worth it. They are doing a lot of, fun and interesting things, particularly in the chips manufacturing space. That's why they just got a bunch of subsidies. However, it's one of those things you got to be patient with because they're not the sexy AMD or NVIDIA. They're not growing, the way that those companies are growing. All right, so let me pull up Intel real quick. They're down 7%. Let me just get the numbers real quick from them. They guided for like $12 billion in revenue last quarter. So how much did they put up? Yeah, they put up $12.7 billion. That's not enough. If they had put up like 13.5, the street might have been excited. $12.7 billion, up 9% year over year. They lost money? What? First quarter GAAP earnings loss? Wait, really? Intel lost money? That's why they're down, dude. Why the fuck is Intel losing money? Intel's a profitable company. Why is Intel losing money? That's why they're down. If they had a loss, I don't think they would be. Hold on, net income. Yeah, they're profitable. Oh, actually, no. 2 quarters ago they lost money. No. Yeah. So for the past 3 quarters they've been profitable. So this is a reverse from the past 3 quarters. That's why they're down. That's why Intel's down. CapEx. Yep. There you go. CapEx. It hurts your net income. It hurts your bottom line. Now Meta increased their CapEx, but they're building out all this AI chip infrastructure from NVIDIA. So investors are like, well, that's probably going to pay dividends in the future. Intel's not growing and they're not as sexy as Meta. And they're trying to build this chips business that they already said is not going to be profitable until 2030. $32 on Intel. Sucks, man. It's a little bit of an overreaction in my opinion. I think they'll be back to normal, but it might take some months before we get there. Or maybe it happens, maybe the street buys up this dip. Intel does have a dividend there. So you will be getting a dividend of 1.42% at least. So we'll see what happens with Intel. Teladoc's flat. Roku's up 7%. Snapchat's up 30%. And then Google's up 12%. Let's go to CNBC. Let's see what they have to say. Get some more coverage on Google. Dude, this is awesome. This is awesome. This is so good. This is so good. Rango says Intel's founder business, they could never figure it out ever. Not sure betting on them is a great idea. Poor track record. That's a fair point. That's a fair point. Pat Gelsinger, I think he's a decent CEO. He's awesome, but building chips and they're essentially competing with TSMC. It's not the easiest thing to do. Okay, here's what Google has to say.
Have some more, D.
Yeah, John, this is big news. Alphabet announcing its first ever dividend of 20 cents per share. You could say maybe this was long in the coming, especially after Meta issued a dividend earlier this year that raised expectations. But here we have it, Google's first ever dividend. It has a buyback program in place for years, but a dividend is something that Wall Street has been looking for. So shares are up even more now, more than 13%.
Wow, look at those big tech stocks all grown up.
Guys, I just realized, hold on. I don't have any Google, but the guy whose sperm hit my mom's egg that made me, he has some mother freaking Google. Let's go, dude. He is up. I have his Robinhood right here. He's up 74% on some Google, dude. There we go. 74.5%. He's good. He knows how to hit it. He can hit it, dude. 75%, $750 on Google. Not bad. Yo, my dad's gonna be so excited, dude. My dad's gonna be so excited. He loves when his stocks go up, even like a penny, dude. He's like, oh, I'm making money. Like my dad's gonna be so excited on this Google thing. This is gonna be great.
Dividends from Meta
Exactly.
and
I
now
haven't
from
heard of
Alphabet
actually.
as well. Going back to Steve Kovac, are we on Microsoft? Steve, what's going on with Microsoft?
Hey there, John. Yeah, I wanted to talk a little bit more about this Azure growth and specifically the amount that Microsoft says AI is contributing to it. So they say 7 percentage points of that 31% of the growth they saw is coming from AI. So as you know, John, a lot of the OpenAI activity and other AI activity running in the cloud, that directly benefits the cloud business. And it's an increase quarter over quarter of the share that AI is making up of that growth. It was 6 points last quarter in the December quarter, and now it's 7 points. So a growing part of the Azure growth is all due to AI, John.
7 points due to AI here in this.
We're gonna do something fun we're gonna do something fun we never do. I'm gonna call my dad live and let's see if he picks up. Maybe he got the notification. Let's just see if he picks up. Let's just see. I want to get his raw reaction if he sees this. Hey, Dad. Okay, so I'm on my stream on my show. So you're on speakerphone, okay? So people can hear you. So Google right now, guess what price it's at?
Google, what is the price right now? Hold on 1 second.
Yeah, no, I'll tell you. I was gonna tell you, but Google's 177 right now.
Hold on 1 second. 179.83.
Yeah,
No, 175.99.
Okay, do you know your average?
What do you mean average?
Your average on Robinhood on Google. Do you know what your average is?
I win my average. I bought it $100.
Okay, yeah, you're up 75% right now. I'm looking at your account on my computer.
Yeah, $75, 75.51%.
Okay, so there's 1,700 people on the live stream with me. Can you just tell? They're all listening to you right now. Can you tell them how you were smart enough to buy Google at $100? Why'd you buy Google?
Because that time was cheap, so I bought it that time.
Okay, and why'd you think $100 was cheap?
Because they split it that time, I think 1 to 20, and that time that was the lowest price, and it looks a good price at that time. And I thought it will move on. The Google is a very reputed company; it will never go down.
All right, so it was cheap. It's a stock that everyone uses, company everyone uses, and they just did a split. So you thought they'd go up. That's a good logic. You got it. You got to fill me in on this when you do this because you didn't tell me about this, and so I don't have any Google. So thanks for that. All right, Dad. I'll talk to you later.
Okay, bye.
Bye. Dude, that was awesome. He made some money. Dude, he's hiding his excitement, dude. You guys don't wait. He is so excited when he makes money. He was hiding. He was probably a little nervous because you guys were. If he makes $1 on a stock, he'll be like, look, it's up right now. So he must be excited. Okay, let's try to get some Snapchat coverage here. Here we go. Let's go to Snapchat.
Stock is shooting higher after the company beat on both the top and bottom lines, reporting earnings of 3 cents per share rather than the 5 cent per share loss that analysts had been anticipating. Revenues of $1.19 billion coming in ahead of estimates of $1.12 billion in revenue. That is growth of 21% in the quarter. It's a serious acceleration from the 5% revenue growth that Snap showed in the fourth quarter. Now, for the first time, Snap is giving a full year operating expense outlook, guiding to OPEX for the full year between $2.425 and $2.525 billion. The company also reporting that its daily active users grew a faster than expected 10% to 422 million, and Snap hit 9 million subscribers for Snapchat Plus. Snap also giving some official guidance for the second quarter, all of it coming in ahead of expectations, guiding to revenues with between 15% and 18% growth in Q2. That's ahead of the consensus estimate. Also guiding to adjusted earnings of between $15 and $45 million, well ahead of the $15.5 million consensus estimate. Also guiding to daily active users, 1 million ahead of expectations. The company is saying it's focusing on diversifying and also accelerating revenue growth. There's going to be a lot to talk about here. I think that expense guidance is key, showing that they have some insight into what's been going to be going on in terms of their costs in the coming year. Now, we're going to be talking about all this and more with Snap CEO Evan Spiegel. We have an exclusive interview with him tomorrow morning in Money Move.
Okay, so we'll hear from the CEO tomorrow and see what he has to say. T-Mobile had earnings. We'll look at that in a second. T-Mobile's down, I think, right now. Are they down? Let's see. This Google move is still insane, dude. This Google moves. T-Mobile is up 1%. Okay, nothing crazy. Snapchat's up 30%. Roku's up a little bit. Intel's up. Intel's down 9%. Microsoft's up 4%. Google's up 12%. Google's the story of the day. Google is the story of the day. Who owns Google in the chat? Put in the chat. Who owns Google in the chat? We're listening to Google. Google usually is first. When does Google start? And then Microsoft goes after. Oh, wow. Holy crap. Google. Sorry, guys. Google's in 4 minutes. Let me get this ready. Let's do this. Google's in 4 minutes. All right. We got it ready to go. I'll load it up in 4 minutes. So Google will be done by 5:30, and then Microsoft starts at 5:30. We might be like slightly late to Microsoft. Probably will be right on time. And then we're good to go. We're good to go. Not bad. Not bad at all for Google. Dude, my dad's argument was so simple. I wish he told me at $100. Dude, he was buying the shit behind my back. I didn't know he was fucking buying. One day I log into his Robinhood, and I'm like, Dad, you're up like 40% on Google. Now he's up 80% on Google. He's going to be so excited when he comes home, dude. He's going to be so excited. My dad, for those that don't know, he's like an entrepreneur. Like, I sit in front of fucking YouTube and I talk and I try to like say some stuff that matters. And like that's what I do all day. This guy is out there in New Jersey just hustling, making money, dude. Like he's like taking cash payments. You know, he like counts his money with his own fucking hands. He's that type of entrepreneur. He had a liquor store when I was growing up. You know, I used to run the cashier at the liquor store. So like he eventually sold that, moved on to some other stuff. But he makes 50 cents, he gets excited. So when he sees stocks going up, and for him, it's like, I'm not doing it. Like for him, he's like, oh, I didn't do nothing. My dad works for every fucking penny he has. So when he sees a stock go up and literally all he did was nothing, he just sat back and Sundar gave a fucking dividend. Like that to him is the greatest thing in the world because he has to do nothing to make this money. And from his perspective as an immigrant, it's like you worked really hard to make every single penny. So he's going to be so happy that Google's up 12%. And he's getting a dividend now. And we can average into the position, you know, because we have a healthy margin of safety. So even if we, you know, add another 30, 40 shares of Google, the average should only be like 130, which if Google's at, you know, 200 by the end of next year, it's not crazy. Not crazy at all. How many shares does your mom have? I don't think my mom has Google. She might. I don't think she has a ton. I know my dad. My dad is Google and Amazon. My dad is basically the NASDAQ. He has all the QQQ stocks. He's losing on Tesla though. His Tesla average is like 260. So the Tesla one is like every time he looks at Tesla, he's like fucking Tesla. But Google, he's getting that one right. All right, here we go. The call should be starting in like why is Apple trying to say, hey, do you want to restart or install these updates now or try tonight? This is the most annoying thing. Like, no, I don't want any updates, dude. Like, don't update my Mac. If I really want to update my Mac, I'll do it. But don't ask me in the middle of Google's earnings call if I want to update my Mac. I need to make sure I properly say try tonight. See, they have that restart button right there. If I press restart, this whole thing would have closed right now. And so they make it so complicated. Okay, here is the call. We should have it in a second. And then we'll talk after the call. We'll see what happens. We'll see how this goes. But it looks like it should be good. Yeah, it should be starting just now. And we'll hear from Sundar. Amit, you leave your computer on at night and it'll do it automatically. Dude, I leave my computer on at night every day. That's the reason why this computer's slowing down. I should actually like shut it down sometimes. I just leave it on sleep. I think that's not a myth. People are like, oh, that's a myth. Like, no. If you close your computer versus leaving it on sleep, I think it saves like the potential of the computer long term. And I'm horrible at doing that. Is Amazon next for a dividend? I don't think so. I think Amazon won't do it. They don't have as much cash as Google. I think Google has too much cash. That's why they have to do it. Microsoft in an hour. So right after Google, we should get Microsoft, and it should be pretty easy to get both. We Indians love when Indian CEOs help us make money. Yup, that's true. Sundar coming through for the Browns. So is Satya. They're coming through for the Browns. How does my dad feel when stocks go down? Dude, he hates it. So that's why when stocks go up, he loves it. But he can't handle when it goes down, dude. He gets pissed off. So it's better but that makes when they go up even better, right? Reddit's up. Wow. Google really pumped up Reddit. You know, that's funny because Google's paying Reddit for their AI. Maybe the market's like seeing a correlation right there for their data. SoFi's 429 pre-market. Okay, we should be starting soon. 1:30 p.m. is 4:30 Eastern. Here we go.
Welcome, everyone. Thank you for standing by for the Alphabet first quarter 2024 earnings conference call. At this time, all participants are in a listen-only mode. After the speaker presentation, there will be a question and answer session. To ask a question during the session, you will need to press star 1 on your telephone. I would now like to hand the conference over to your speaker today, Jim Friedland, Director of Investor Relations. Please go ahead.
Thank you. Good afternoon, everyone, and welcome to Alphabet's first quarter 2024 earnings conference call. With us today are Sundar Pichai, Philip Schindler, and Ruth Porat. Now, I'll quickly cover the safe harbor. Some of the statements that we make today regarding our business, operations, and financial performance may be considered forward-looking. Such statements are based on current expectations and assumptions that are subject to a number of risks and uncertainties. Actual results could differ materially. Please refer to our Forms 10-K and 10-Q, including the risk factors. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and non-GAAP financial measures. A reconciliation of non-GAAP to GAAP measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now, I'll turn the call over to Sundar.
Thank you, Jim, and hello, everyone. It was a great quarter led by strong performance from Search, YouTube, and Cloud. Today, I want to share how we are thinking about the business and the opportunity more broadly. Of course, that's heavily focused on AI and Search. Then I'll take you through some highlights from the quarter in Cloud, YouTube, and beyond. Let's discuss our momentum and strategy. Taking a step back, it took Google more than 15 years to reach $100 billion in annual revenue. In just the last 6 years, we've gone from $100 billion to more than $300 billion in annual revenue. Of course, Search continues to power that, as you see in our Q1 results. But in addition, we expect YouTube overall and Cloud to exit 2024 at a combined annual run rate of over $100 billion. This shows our track record of investing in and building successful new growing businesses. Now, let's look at how well we are positioned for the next wave of AI innovation and the opportunity ahead. There are 6 points to make. 1, research leadership. 2, infrastructure leadership. 3, innovation in search. 4, our global product footprint. 5, velocity in execution. 6, monetization paths. First, our foundation of research leadership. We've been an AI-first company since 2016, pioneering many of the modern breakthroughs that power AI progress for us and for the industry. Last week, we further consolidated teams that build AI models under Google DeepMind. This will help simplify development and establish a single access point for our product teams as they build generative AI applications with these models. The teams are making rapid progress developing Gemini and other models. In February, we rolled out Gemini 1.5 Pro, which shows dramatic performance enhancements across a number of dimensions. It includes a breakthrough in long context understanding, achieving the longest context window of any large-scale foundation model yet. Combining this with Gemini's native multimodal understanding across audio, video, text, code, and more, it's highly capable. We are already seeing developers and enterprise customers enthusiastically embrace Gemini 1.5 and use it for a wide range of things. Beyond Gemini, we have built other useful models, including our Gemma open models, as well as image and visual models and others. Second, infrastructure leadership. We have the best infrastructure for the AI era. Building world-leading infrastructure is in our DNA, starting in our earliest days when we had to design purpose-built hardware to power search. Our data centers are some of the most high-performing, secure, reliable, and efficient in the world. They've been purpose-built for training cutting-edge AI models and designed to achieve unprecedented improvements in efficiency. We have developed new AI models and algorithms that are more than 100 times more efficient than they were 18 months ago. Our custom TPUs, now in their 5th generation, are powering the next generation of ambitious AI projects. Gemini was trained on and is served using TPUs. We are committed to making the investments required to keep us at the leading edge in technical infrastructure. You can see that from the increases in our capital expenditures. This will fuel growth in cloud, help us push the frontiers of AI models, and enable innovation across our services, especially in search. AI innovations in search are the third and perhaps the most important point I want to make. We have been through technology shifts before, to the web, to mobile, and even to voice technology. Each shift expanded what people can do with search and led to new growth. We are seeing a similar shift happening now with generative AI. For nearly a year, we've been experimenting with SGE in search labs across a wide range of queries. And now we are starting to bring AI overviews to the main search results page. We are being measured in how we do this, focusing on areas where GenAI can improve the search experience while also prioritizing traffic to websites and merchants. We have already served billions of queries with our generative AI features. It's enabling people to access new information, to ask questions in new ways, and to ask more complex questions. Most notably, based on our testing, we are encouraged that we are seeing an increase in search usage among people who use the new AI overviews, as well as increased user satisfaction with the results. And with Circle to Search, people can now circle what they see on their Android screens, ask a question about an image or object in a video, and get an AI overview with Lens. Fourth, our global product footprint beyond search. We have 6 products with more than 2 billion monthly users, including 3 billion Android devices. 15 products have 500 million users, and we operate across 100+ countries. This gives us a lot of opportunities to bring helpful GenAI features and multimodal capabilities to people everywhere and improve their experiences. We have brought many new AI features to Pixel, Photos, Chrome, Messages, and more. We are also pleased with the progress we are seeing with Gemini and Gemini Advanced through the Gemini app on Android and the Google app on iOS. Fifth, improved velocity and execution. We've been really focused on simplifying our structures to help us move faster. In addition to bringing together our model building teams under Google DeepMind, we recently unified our ML infrastructure and ML developer teams to enable faster decisions, smarter compute allocation, and a better customer experience. Earlier this year, we brought our search teams together under one leader. And last week, we took another step, bringing together our platforms and devices teams. The new combined team will focus on delivering high-quality products and experiences, bolstering the Android and Chrome ecosystems, and bringing our best innovations to partners faster. We also remain focused on long-term efforts to durably re-engineer our cost base. You can see the impact of this work reflected in our operating margin improvement. We continue to manage our headcount growth and align teams with our highest priority areas. This speeds up decision-making, reduces layers, and enables us to invest in the right areas. Beyond our teams, we are very focused on our cost structures, procurement, and efficiency. And a number of technical breakthroughs are enhancing machine speed and efficiency, including the new family of Gemini models and a new generation of TPUs. For example, since introducing SGE about a year ago, machine costs associated with SGE responses have decreased 80% from when first introduced in labs, driven by hardware, engineering, and technical breakthroughs. We remain committed to all of this work. Finally, our monetization path. We have clear paths to AI monetization through ads and cloud, as well as subscriptions. Philip will talk more about new AI features that are helping advertisers, including bringing Gemini models into Performance Max. Our cloud business continues to grow as we bring the best of Google AI to enterprise customers and organizations around the world. And Google One now has crossed 100 million paid subscribers. And in Q1, we introduced a new AI premium plan with Gemini Advanced. Okay, those are the 6 points. So now let me turn to quarterly highlights from Cloud and YouTube in a bit more detail. In Cloud, we have announced more than 1,000 new products and features over the past 8 months. At Google Cloud Next, more than 300 customers and partners spoke about their generative AI successes with Google Cloud, including global brands like Bayer, Cintas, Mercedes-Benz, Walmart, and many more. Our differentiation in cloud begins with our AI hypercomputer, which provides efficient and cost-effective infrastructure to train and serve models. Today, more than 60% of funded GenAI startups and nearly 90% of GenAI unicorns are Google Cloud customers. And customers like PayPal and Kakao Brain are choosing our infrastructure. We offer an industry-leading portfolio of NVIDIA GPUs along with our TPUs. This includes TPU v5p, which is now generally available, and NVIDIA's latest generation of Blackwell GPUs. We also announced Axion, our new Google design and ARM-based CPU. In benchmark testing, it has performed up to 50% better than comparable x86-based systems. On top of our infrastructure, we offer more than 130 models, including our own models, open source models, and third-party models. We made Gemini 1.5 Pro available to customers, as well as Imagen 2.0 at Cloud Next. And we shared that more than 1 million developers are now using our generative AI across tools, including AI Studio and Vertex AI. We spoke about how customers like Bristol-Myers Squibb and Etsy can quickly and easily build agents and connect them to their existing systems. For example, Discover Financial has begun deploying GenAI-driven tools to its nearly 10,000 call center agents to achieve faster resolution times for customers. Customers can also now ground their GenAI with Google Search and their own data from their enterprise databases and applications. In Workspace, we announced that organizations like Uber, Pepperdine University, and PennyMac are using Gemini in Google Workspace, our AI-powered agent that's built right into Gmail, Docs, Sheets, and more. We also announced Google Vids, a new application to create stories in short video format. And we introduced Gemini for meetings and messaging and Gemini Security for Workspace. Customers are choosing Workspace because they have deep trust in our powerful security and privacy features. Our cloud business is now widely seen as the leader in cybersecurity. I saw this firsthand when I went to the Munich Security Conference in February. Cybersecurity analysts are using Gemini to help spot threats, summarize intelligence, and take action against attacks, helping companies like American Family Insurance aggregate and analyze security data in seconds instead of days. Turning next to YouTube, which continues to grow and lead in streaming. We announced that on average, viewers are watching over 1 billion hours of YouTube content on TVs daily. AI experiments like Dream Screen will give anyone the ability to make AI-generated backgrounds for YouTube Shorts. And on subscriptions, which are increasingly important for YouTube, we announced that in Q1, YouTube surpassed 100 million music and premium subscribers globally, including trialers. And YouTube TV now has more than 8 million paid subscribers. Finally, in other bets, Waymo's fully autonomous service continues to grow ridership in San Francisco and Phoenix with high customer satisfaction, and we started offering paid rides in Los Angeles and testing rider-only trips in Austin. Overall, it was a great quarter, and there's more to come. I/O is in less than 3 weeks, followed by Brandcast and Google Marketing Live. I want to thank our employees around the world who are at the heart of this progress and who continue to focus on building innovative products, helpful services, and new opportunities for businesses and partners around the world. Thank you. Philip.
Thanks, Sundar, and hi, everyone. Google Services revenue of $70 billion were up 14% year-on-year. Search and other revenues grew 14% year-on-year, led again by solid growth in the retail vertical, with particular strength from APAC-based retailers, which began in the second quarter of 2023. YouTube ads revenues were up 21% year-on-year, driven by growth in both direct response and brand. Network revenues declined 1% year-on-year. In subscriptions, platforms, and devices, year-on-year revenues increased 18%, driven again by strong growth in YouTube subscriptions. Let's now talk about a few highlights from the quarter from a product innovation and advertising performance perspective. First, it bears repeating that AI innovation across our ads ecosystem is core to every aspect of our product portfolio, from targeting, bidding, creative, measurement, and across campaign types. We've talked about how solutions like smart bidding use AI to predict future ad conversions and their value in helping businesses stay agile and responsive to rapid shifts in demand, and how products like Broadmatch leverage LLMs to match ads to relevant searches and help advertisers respond to what millions of people are searching for. This is foundational. As advances accelerate in our underlying AI models, our ability to help businesses find users at speed and scale and drive ROI just keeps getting better. We're especially excited about the doors GenAI is opening for creative capabilities, helping deliver on the premise of getting the right ad to the right user in the right moment. Look at Performance Max. In February, we rolled Gemini into PMax. It's helping curate and generate text and image assets so businesses can meet PMax asset requirements instantly. This is available to all US advertisers and starting to roll out internationally in English, and early results are encouraging. Advertisers using PMax asset generation are 63% more likely to publish a campaign with good or excellent ad strength. And those who improve their PMax ad strength to excellent see 6% more conversions on average. We're also driving improved results for businesses opting into automatically created assets, which are supercharged with GenAI. Those adopting ACA see on average 5% more conversions at a similar cost per conversion in Search and Performance Max campaigns. And then there's Demand Gen. Advertisers are loving its ability to engage new and existing customers and drive purchase consideration across our most immersive and visual touchpoints like YouTube, Shorts, Gmail, and Discover. Hollywood film and TV studio Lionsgate partnered with Horizon Media to test what campaign type would deliver the most ticketing page views for its The Hunger Games, Ballad of Songbirds, and Snakes film. Over a 3-week test, Demand Gen was significantly more efficient versus social benchmarks, with an 85% more efficient CPC and 96% more efficient cost per page view. Lionsgate has since rolled out Demand Gen for 2 new titles. We're also bringing new creative features to Demand Gen. Earlier this month, we announced new generative image tools to help advertisers create high-quality assets in a few steps with a few simple prompts. This will be a win for up-leveling visual storytelling and testing creative concepts more efficiently. And then there's obviously search generative experience, which Sundar talked about. I'll add that innovation in the user experience on search has historically opened up new opportunities for advertisers. We saw this when we successfully navigated from desktop to mobile. We're continuing to experiment with new ad formats, including search and shopping ads alongside search results in SGE. And we shared in March how folks are finding ads either above or below the SGE results helpful. We're excited to have a solid baseline to keep innovating on and confident in the role SGE, including ads, will play in delighting users and expanding opportunities to meet user needs. Which brings me to search and our strong performance in the first quarter. In Q1, retail was again a top contributor. Our focus remains on driving profitability and growth for retailers, helping them optimize digital performance for both online and offline, as well as innovate across our shopping and merchant experiences. Highlights include continued upsides for retailers, leading into agile budget and bidding strategies across search, PMax, or both. Take-home goods retailer IKEA, who leaned into Google's store sales measurement to understand its total omni-channel revenue opportunity across search. By measuring 2.3 times more revenue and using value-based bidding solutions to bid to its omni-channel customers, IKEA drove a significant increase in omni revenue in Q1 and is now scaling this strategy globally. We also expanded local inventory ads into 23 countries, helping drive shopper confidence and offline sales. Retailers can convert intent into action by showcasing in-store availability, pricing, pickup options, and more, all in one ad format. Moving to YouTube. Last quarter, I went deep into our strategy. It all starts with creation, which drives viewership, which leads to monetization. A few updates to build on Sundar's remarks. First, creation, which is all about giving creators the tools to create amazing content, grow their audiences, and build their businesses. In 2023, more people created content on YouTube than ever before, and the number of channels uploading shorts year on year grew 50%. We also hit a new milestone with 3 million plus channels in our YouTube partner program. We recently shared that YPP has paid out more than any other creator monetization platform, including over $70 billion to creators, artists, and media companies over the last 3 years. From a viewer's perspective, watch time across YouTube continues to grow, with strength in both Shorts and CTV. According to Nielsen, YouTube has been the leader in US streaming watch time for the last 12 plus months. In the first quarter, Living Room benefited from a combination of strong watch time growth, innovation in the user and advertiser experience, and a shift in brand advertising budgets from linear TV to YouTube. Viewers are watching YouTube because they expect to access everything in one place, across screens and formats, their favorite creators, live sports, breaking news, educational content, movies, music, and more. And advertisers continue to lean in to find audiences they can't find elsewhere. Which brings me to monetization. We're pleased with our Q1 performance across both our ad-supported and subscription offerings. Sundar covered subscription growth. On the ads front, direct and brand were both strong this quarter. Shorts monetization continued to improve, with Shorts ads now supported on mobile, tablet, living room, and desktop, and available to both performance and brand advertisers. In the US, the monetization rate of Shorts relative to in-stream viewing has more than doubled in the past 12 months, including a 10-point sequential improvement in the first quarter alone. Just last week, we introduced new ways for brands to get the most out of their Shorts ads with new lineups on YouTube Select, including sports, beauty, fashion and lifestyle, and entertainment. For YouTube advertisers, increasing brand lift is one of the core goals. In Q1, we saw strong traction from the introduction of a pause ads pilot on connected TVs, a new non-interruptive ad format that appears when users pause their organic content. Initial results show that pause ads are driving strong brand lift results and are commanding premium pricing from advertisers. Before I wrap, 2 quick highlights on how we're helping our partners transform and accelerate impact with the best across Google. Number 1, to help McDonald's build the restaurant of the future, we're deepening our partnership across cloud and ads. Part of this includes them connecting Google Cloud's latest hardware and data technologies across restaurants globally and starting to apply Gen AI to enhance its customer and employee experiences. Number 2, WPP. At Google Cloud Next, we announced a new collaboration that will redefine marketing through the integration of our Gemini models with WPP Open, WPP's AI-powered marketing operating system already used by more than 35,000 of its people and adopted by key clients, including the Coca-Cola Company, L'Oreal, and Nestle. We're just getting started here and excited about the innovation this partnership will unlock. With that, a huge thank you to our customers and partners, many of whom we're excited to see at Google Marketing Live and Brandcast in just a few weeks. And a huge thank you, as always, to our incredible teams for their agility and hard work this quarter. Ruth, you're up.
Thank you, Philip. We are very pleased with our financial results for the first quarter, driven in particular by strength in search and cloud, as well as the ongoing efforts to durably re-engineer our cost base. My comments will be on year-over-year comparisons for the first quarter unless I state otherwise. I will start with results at the Alphabet level, followed by segment results, and conclude with our outlook. For the first quarter, our consolidated revenues were $80.5 billion, up 15% or up 16% in constant currency. Search remained the largest contributor to revenue growth. In terms of total expenses, the year-on-year comparisons reflect the impact of the restructuring charges we took in the first quarter of 2023 of $2.6 billion, as well as the $716 million in employee severance and related charges in the first quarter of 2024. As you can see in our earnings release, these charges were allocated across the expense lines in other cost of revenues and OPEX based on associated headcount. To help with year-on-year comparisons, we included a table in our earnings release to adjust other cost of revenues, operating expenses, operating income, and operating margin to exclude the impact of severance and related office space charges in the first quarter of 2023 versus 2024. In terms of expenses, total cost of revenues was $33.7 billion, up 10%. Other cost of revenues was $20.8 billion, up 10% on a reported basis, with the increase driven primarily by content acquisition costs associated with YouTube, given the very strong revenue growth in both subscription offerings and ad-supported content. On an adjusted basis, other cost of revenues were up 13% year-on-year. Operating expenses were $21.4 billion, down 2% on a reported basis, primarily reflecting expense decreases in sales and marketing and G&A, offset by an increase in R&D. The largest single factor in the year-on-year decline in G&A expenses was lower charges related to legal matters. On an adjusted basis, operating expenses were up 5%, reflecting first in R&D an increase in compensation expense, primarily for Google DeepMind and Cloud, and second, in sales and marketing, a slight increase year-on-year, reflecting increases in compensation expense, primarily for Cloud sales. Operating income was $25.5 billion, up 46% on a reported basis, and our operating margin was 32%. On an adjusted basis, operating income was up 31%, and our operating margin was 33%. Net income was $23.7 billion, and EPS was $1.89. We delivered free cash flow of $16.8 billion in the first quarter and $69.1 billion for the trailing 12 months. We ended the quarter with $108 billion in cash and marketable securities. Turning to segment results. Within Google Services, revenues were $70.4 billion, up 14%. Google Search and other advertising revenues of $46.2 billion in the quarter were up 14%, led again by growth in retail. YouTube advertising revenues of $8.1 billion were up 21%, driven by both direct response and brand advertising. Network advertising revenues of $7.4 billion were down 1%. Subscriptions, platforms, and devices revenues were $8.7 billion, up 18%, primarily reflecting growth in YouTube subscription revenues. TAC was $12.9 billion, up 10%. Google Services operating income was $27.9 billion, up 28%, and the operating margin was 40%. Turning to the Google Cloud segment, revenues were $9.6 billion for the quarter, up 28%, reflecting significant growth in GCP with an increasing contribution from AI and strong Google Workspace growth, primarily driven by increases in average revenue per seat. Google Cloud delivered operating income of $900 million and an operating margin of 9%. As to our other bets for the first quarter, revenues were $495 million, benefiting from a milestone payment in one of the other bets. The operating loss was $1 billion. Turning to our outlook for the business, with respect to Google Services, first within advertising, we are very pleased with the momentum of our ads businesses. Search had broad-based strength across verticals. In YouTube, we had acceleration in revenue growth driven by brand and direct response. Looking ahead, 2 points to call out. First, results in our advertising business in Q1 continued to reflect strength in spend from APAC-based retailers, a trend that began in the second quarter of 2023 and continued through Q1, which means we will begin lapping that impact in the second quarter. Second, the YouTube acceleration in revenue growth in Q1 reflects, in part, lapping the negative year-on-year growth we experienced in the first quarter of 2023. Turning to subscriptions, platforms, and devices, we continue to deliver significant growth in our subscriptions business, which drives the majority of revenue growth in this line. The sequential quarterly decline in year-on-year revenue growth for the line in Q1 versus Q4 reflects in part the fact that we had only 1 week of Sunday Ticket subscription revenue in Q1 versus 14 weeks in Q4. Looking forward, we will anniversary last year's price increase in YouTube TV starting in May. With regard to platforms, we are pleased with the performance in Play, driven by an increase in buyers. With respect to Google Cloud, performance in Q1 reflects strong demand for our GCP infrastructure and solutions, as well as the contribution from our workspace productivity tools. The growth we are seeing across cloud is underpinned by the benefit AI provides for our customers. We continue to invest aggressively while remaining focused on profitable growth. As we look ahead, 2 points that will affect sequential year-on-year revenue growth comparisons across Alphabet. First, Q1 results reflect the benefit of leap year, which contributed slightly more than 1 point to our revenue growth rate at the consolidated level in the first quarter. Second, at current spot rates, we expect a larger headwind from foreign exchange in Q2 versus Q1. Turning to margins, our efforts to durably re-engineer our cost base are reflected in a 400 basis point expansion of our Alphabet operating margin year-on-year, excluding the impact of restructuring and severance charges in both periods. You can also see the impact in the quarter-on-quarter decline in headcount in Q1, which reflects both actions we have taken over the past few months and a much slower pace of hiring. As we have discussed previously, we are continuing to invest in top engineering and technical talent, particularly in cloud, Google DeepMind, and technical infrastructure. Looking ahead, we remain focused on our efforts to moderate the pace of expense growth in order to create capacity for the increases in depreciation and expenses associated with the higher levels of investment in our technical infrastructure. We believe these efforts will enable us to deliver full year 2024 Alphabet operating margin expansion relative to 2023. With respect to CapEx, our reported CapEx in the first quarter was $12 billion, once again driven overwhelmingly by investment in our technical infrastructure, with the largest component for servers, followed by data centers. The significant year-on-year growth in CapEx in recent quarters reflects our confidence in the opportunities offered by AI across our business. Looking ahead, we expect quarterly CapEx throughout the year to be roughly at or above the Q1 level, keeping in mind that the timing of cash payments can cause variability in quarterly reported CapEx. With regard to other bets, we similarly have work streams underway to enhance overall returns. Finally, as I trust you saw in the press release, we are very pleased to be adding a quarterly dividend of 20 cents per share to our capital return program, as well as a new $70 billion authorization in share repurchases. The core of our capital allocation framework remains the same, beginning with investing aggressively in our business, as you have heard us talk about today, given the extraordinary opportunities ahead. We view the introduction of the dividend as further strengthening our overall capital return program. Thank you. Sundar, Philip, and I will now take your questions.
All right, Q&A.
Thank you. As a reminder, to ask a question, you will need to press *1 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated.
Google's up 14%.
Our first question comes from Brian Nowak with Morgan Stanley. Please go ahead.
Great. Thanks for taking my question. I have two. The first one, I wanted to ask about overall search behavior. Philip, I know you talked in the past about how overall query trends continue to grow. Can I ask you to drill a little bit more into monetizable and commercial query trends? Have there been any changes in sort of your commercial query trends growth? There's been all these new entrants moving around in e-commerce, is my first one. Then the second one for Ruth, when you talked about sort of more efforts to moderate expense growth from here, can you just sort of give us some examples of areas where you still see the potential for more optimization or work streams in place to continue to durably re-engineer the OpEx space as we go throughout 2024? Thanks.
Thanks, Brian. To your first question, look, I think broadly, we've always found that over many years when things work well on the organic side, monetization follows. So typically, the trends we see carry over well. Overall, I think with generative AI in search, with our AI overviews, we are definitely, I think we will expand the type of queries we can serve our users. We can answer more complex questions well. And in general, that all seems to carry over across query categories. Obviously, it's still early, and we are going to be measured and put user experience at front, but we are positive about what this transition means.
And on the second question, in terms of the various work streams, as both Sundar and I said, we remain very focused on ongoing efforts to slow the pace of expense growth, what we've been calling durably re-engineering our cost base. And I made this point in opening comments, but we are very cognizant of the increasing headwind we have from higher depreciation and expenses associated with the higher CapEx. And so these efforts are ongoing, and they're very much the same that we've talked with you about previously. It starts with product and process prioritization, all of the work around organizational efficiency and structure. These are ongoing. And so as an example, the work that Sundar talked about, combining devices and services with our platforms and ecosystems, product area is a really good example, because unifying the teams not only helps us deliver higher quality products and experiences, but we think it enables us to move with greater velocity and efficiency. And then the other work streams we've talked to you about in the past, like all of the work around technical infrastructure, which Sundar alluded to, streamlining operations within the company through the use of AI, what we're doing with procurement with our suppliers and vendors, which he also referenced, the work you've seen on real estate optimization. These are all ongoing work streams, which is why we have them under the umbrella durably re-engineering our cost base, and they are ongoing.
Our next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. Sundar, you talked about bringing more generative AI features into the main search page. Can you just talk about what kind of queries or scenarios you think that's working best for so far, and just how we should think about the cadence of continuing to adopt more of those features within core search? And then, Ruth, on CapEx spending, the $12 billion in 1Q, can we assume that run rating that and above is reasonable for this year? And I know it's very early, but should we generally expect higher CapEx next year as well?
This is a good question.
Thanks, Doug. On SGE in search, look, I think it tends to we are seeing early confirmation of our thesis that this will expand the universe of queries where we are able to really provide people with a mix of factual answers, a link to sources across the web, and bring a variety of perspectives, all in an innovative way. And we've been rolling out AI overviews in the US and UK, trying to mainly tackle queries which are more complex, where we think the SGE will clearly improve the experience. We've already served billions of queries, and it seems to cut across categories. But we are still continuing our testing, and we'll keep. We are metrics driven in these areas, and so But I am optimistic that it clearly improves the user experience. Users are telling us that, and we are seeing it in our metrics, and we'll continue evolving it through the course of this year.
And then in terms of CapEx, as I said in opening comments, we do expect the quarterly CapEx throughout the year to be roughly at or above the $12 billion cash CapEx we had here in Q1. As I said, you can always have variability in the reported quarterly CapEx just due to the timing of cash payments. But roughly at or above this level. And it really goes to Sundar's comment, opening comment, that we're very committed to making the investments required to keep us at the leading edge in technical infrastructure to support the growth in cloud, all the innovation in search that he and Philip have spoken about, and our lead with Gemini. I will note that most, nearly all, I should say, of the CapEx was in our technical infrastructure. We expect that our investment in office facilities will be about less than 10% of the total CapEx in 2024, roughly flat with our CapEx in 2023, but is still there. And then with respect to 2025, as he said, it's premature to comment, so nothing to add on that.
Great. Thank you.
Great
Our
answer.
next question comes from Eric Sheridan with Goldman Sachs. Please go ahead.
They answered the AI stuff clearly.
Thanks so much. Maybe just one question of the big picture nature for Sundar. Sundar, if we come back to your earlier comments at the beginning of the call and framing up longer-term initiatives and longer-term narratives, wanted to know if you could talk a little bit about both the opportunities and the challenges of operating at scale in a time like this where there's a lot of technology innovation going on, and how you see the elements of trying to strike a balance towards moving the organization forward while still, continuing to both invest for growth as well as balance margins. Thanks so much.
Thanks, Eric. Great question. Obviously, I think the AI transition, I think it's a once in a generation kind of an opportunity. We've definitely, been gearing up for this for a long time. You can imagine we started building TPUs in 2016. So we've definitely been gearing up for a long time. The real opportunities we see is the scale of, research and innovation, which we've built up and are going to continue to deliver. I think for the first time, we can work on AI in a horizontal way, and it impacts the entire breadth of the company, be it search, be it YouTube, be it cloud, be it Waymo, and so on. And we see rapid pace of innovation in that underlying. So it's a very leveraged way to do it, and I see that as a real opportunity ahead. In terms of the challenges, I think making sure. I think we are constantly. I think it's been a mindset shift which we've been driving across the company to make sure that we are embracing this opportunity, but being very efficient in how we are approaching it. Making sure we are redirecting our people to the highest priorities across the company, building on our 20 years of experience in driving machine efficiencies year on year, so that we can put our dollars to work as efficiently as possible. So making sure balancing all of that, moving forward in a very bold and responsible way at the same time. Those are the important things to get right from my perspective.
Our next question comes from Stephen Ju with UBS. Your line is now open.
Right. Thank you so much. So, hi, Philip. I think it's approaching the 2-year anniversary for the launch of ads on YouTube Shorts, and I think you've given us an update on monetization pickup sequentially. But, with that in mind, I think, YouTube has launched an array of ad products and automation tools to help advertisers transfer what they're doing to the vertical screen. So, how is this translating into buy-in among your advertiser clients? And secondly, based on what you've seen over the last 2 years, are there any structural reasons that you can cite as to why the monetization cannot match what is already the case on the horizontal screen? Thanks.
Yeah, look, this is a great question. First of all, let's start with the fact that YouTube performance was very strong and this quarter. And on Shorts, specifically in the US, I mentioned how the monetization rate of Shorts relative to in-stream viewing has more than doubled in the last 12 months. I think that's what you were referring to. Yes, we're obviously very happy with this development. The way to think about it is advertisers really only spend with us when they see a positive ROI. So you can assume that this wouldn't be happening unless it were to work for advertisers in the short term and also in the long term. That's an important part, I think. Overall, Shorts is a long-term bet for the business. It has really helped us respond to both creator and viewer demand for short-form video. We talked about the strong growth, averaging 70 billion daily views. I mentioned the number of channels uploading has increased 50% year over year. So again, very happy with this development. And to your question, structural reasons, whether we can't get to a match here, I have a hard time seeing those at the moment over time.
Okay, thank you.
Not bad answers.
Our next question comes from Justin Post with Bank of America. Your line is now open.
They're doing good.
Great, thank you. I'm going to ask another one about CapEx. It seems to be your biggest investment area. Just first, you saw the big uptick the last 2 quarters, but you've been investing in AI for years. Is the uptick because supply is getting easier to get, or do you see more opportunities with the available supply to really fuel AI? So it has the GPUs and everything gotten better that you feel more investing more. And then thinking about the returns both for advertising and cloud on the CapEx, do you feel like this is a higher cost of doing business, or do you think this is an opportunity to even get better returns on your capital spend than you've had in the past? Thank you.
So the increase in CapEx, as Sundar said and I said, really reflects the opportunity we continue to see across the company. It starts with all that we're doing in support of the foundation model, all the Gemini foundational model, but then also clearly the work across cloud on behalf of cloud customers and the growth that we're seeing with GCP and the infrastructure work there. And then, of course, as both Sundar and Philip talked about, the application across search, YouTube, and more broadly, the services that we're able to offer. So it's the growing application and our focus on ensuring that we have the compute capacity to deliver in support of the services and opportunities we see across Alphabet. And it really goes to the second part of your question, which is that as we're investing in CapEx and applying it across our various businesses, it opens up more service and products, which bring revenue opportunities. And we're very focused on the monetization opportunity. It does underlie everything that we're doing in Google Services and Google Cloud. And as Sundar noted, we're at the same time very focused on the efficiency of all elements of delivering that compute capacity from hardware, software, and beyond.
Our next question comes from Mark Mahaney with Evercore. Your line is now open.
Great, thank you. This is Jan Lee for Mark Mahaney. A couple questions. One, just maybe an extension on the search query question from before. More like search volume and maybe in the context of the off Google environment, like AI chatbot, for example, we've seen kind of Meta AI directing to Google search results. Do you think there's actually a scenario where like AI system can create a step function change in search volume or use cases off Google? Do you think give us more color on what are you seeing right now or what are you expecting to see in that area? And then the second question on just the comment of YouTube and cloud exiting at 100 billion run rate. What is informing this outlook of visibility for you? If you can talk about, is it driven by any sort of cloud demand inflection or step change in the Gen AI workload demand? If you can flesh it out a little bit, thanks a lot.
On your first question, look, I said this before, but to be clear, we view this moment as a positive moment for search. And I think it allows us to evolve our product in a profound way. And search is a unique experience. People come and they get to, be it if you want answers, if you want to explore more, if you want to get perspectives from across the web, and to be able to do it across the breadth and depth of everything they are looking for, and the innovation you would need to keep that up. I think it's what we've been building on for a long time, and so I feel we are extraordinarily well set up, particularly given the innovation path we are on. And overall, I view this moment as a positive moment. So that's how I would say it on the second part, Ruth.
I'm sorry, what was the
YouTube and cloud.
I don't blame her, dude. I forgot it too. I don't blame her.
Yeah, like in terms of your comment about 100 billion exit rate for YouTube and cloud, what's driving this visibility for you, and any kind of inflection you're seeing in the cloud demand?
Oh, I would just say from Sundar's opening comments, it's just the ongoing momentum that we've seen in the business that we've been talking about, the ongoing growth, the strong performance. And so what we were really getting at in that comment, what Sundar was getting at, is that we've continued to build strong businesses over time, and that just helps dimension it. We had similar comments last quarter when you talk about our subscription business. We're really proud of all the work that teams are doing across the company, building new, strong opportunities, delivering for our users, for customers, for advertisers in profound ways. And so it was just helping to dimension what we have built over the years.
Our next question comes from Ken Gorelski with Wells Fargo. Your line is now open.
Thank you very much. Two, if I may. First, on GCP, you had nice acceleration in the quarter. Could you talk a little bit about the opportunities and constraints upon GCP's ability to continue to address that large addressable market and accelerate growth? Is it more sales oriented? Is it more product sales solutions, or both? And do you plan to address most of these organically, or could a partner approach work for you? And then the second one, just more detailed on YouTube and sports rights. Could you reiterate your view on further live sports rights? There's some larger, mostly in the U.S. league rights coming up soon, and will be more over the next several years. Could you just talk about your philosophy there beyond NFL Sunday Ticket? Thank you.
Thanks. Look, on the cloud side, obviously, it's definitely a point of inflection overall. I think the AI transformation is making everyone think about their whole stack, and we are engaged in a number of conversations. I think be it AI infrastructure, people really looking to Vertex AI, given our depth and breadth of model choice, or using Workspace to transform productivity in your workplace, etc. So I think the opportunities there are all related to that, both all the work we have built up and AI being a point of inflection in terms of driving conversations. I think you will see us do it both organically and with a strong partner program as well. So we'll do it with a combination. And the challenges here are always, and there are switching costs to cloud, and the challenges we see is how do we make it easier for people. There's a lot of interest, but there's definitely barriers in terms of people switching, and so that's an area where we are constantly investing to make it easier for our customers.
And with regard to your sports rights question, look, I mean, we've had longstanding and significant partnerships with the most popular sports league here in the US, around the globe, federations, teams, athletes, broadcasters. And obviously these partnerships in combination with our very vast audience of sports fans drives investment in subscription experiences across many offerings, NFL Sunday Ticket, YouTube TV, YouTube primetime channels, and so on. But there's nothing that we have to announce at the moment. We're obviously always looking at where we can create more value for our users, for our advertisers, for creators, but nothing specific to talk about at this moment.
Thank you.
Our next question comes from Ross Sandler with Barclays. Your line is now open.
Great. Sundar, I had a question about smartphone-based AI searches. So you guys are powering all these new AI interactions and searches on Pixel and on Samsung devices, and I think there's speculation that Gemini might be used on iOS in the future state. So the question is, if users start searching on smartphones and those searches are basically rendered on the model on the phone without accessing the web, how do you guys anticipate monetizing some of these smartphone-based behaviors that are kind of run on the edge? Any thoughts on that?
Look, I think if you look at what users are looking for, people are looking for information and an ability to connect with things outside. So I think there'll be a set of use cases which you'll be able to do on device. But for a lot of what people are looking to do, I think you will need the richness of the cloud, the web, and you have to deliver it to users. So I think so. Again, to my earlier comments, I think through all these moments, you saw what we have done with Samsung, with Circle to Search. I think it gives a new way for people to access search conveniently wherever they are. And so I view this as positive way to bring our services to users in a more seamless manner. So I think it's positive from that perspective. In terms of on-device versus cloud, there will be needs which can be done on device, and we should to help it from a privacy standpoint. But there are many, many things for which people will need to reach out to the cloud. And so I don't see that as being a big driver in the on-cloud versus off-cloud in any way.
And our last question comes from Colin Sebastian with Baird. Your line is now open.
Thanks, and good afternoon. I guess first, follow up on some of the questions on SGE and the core search. I guess I'm wondering, along with some of those changes in behavior, is there a way to quantify that overall engagement shift, whether that's an increase in time spent or increase in or the level of increase in queries for both sort of traditional search as well as more generative answers? And then secondly, on the hardware roadmap, I assume later this year we'll hear more about some of the products. But any areas of a particular focus or that you would point out that we should keep in mind in terms of hardware launches in the back half? Thank you.
Look, on the first question on search, not much more to add to what I said. But what we have seen, and remember, we've been in live experiments just for a few weeks and in US and UK and on a slice of our queries and all indications are positive that it improves user satisfaction. We see an increase in engagement, but I see this as something which will play out over time. But if you were to step back, this moment, there were a lot of questions last year, and we always felt confident and comfortable that we would be able to improve the user experience. People question whether these things would be costly to serve, and we are very, very confident we can manage the cost of how to serve these queries. People worried about latency. I think we are, when I look at the progress we have made in latency and efficiency, we feel comfortable. There are questions about monetization, and based on our testing so far, I'm comfortable and confident that we'll be able to manage the monetization transition here well as well. It'll play out over time, but I feel we are well positioned. And more importantly, when I look at the innovation that's ahead and the way the teams are working hard on it, I am very excited about the future ahead.
Thank you. And that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
Thanks, everyone, for joining us today. We look forward to speaking with you again on our second quarter 2024 call. Thank you, and have a good evening.
All right, that's
thank you, everyone.
That's Google, folks. We got Microsoft in 2 minutes, so not a lot of time to talk and analyze because we got Microsoft literally in 2 minutes. So we'll get started in a second. But the stock's done very well. First of all, I think Sundar crushed. I think he absolutely crushed. I don't think Google sells off tomorrow. But over, sell in May, go away. If May's a little tough, inflation's a little tough, maybe we could see a little bit of a pullback. Obviously, it's pumping a lot right now. But nothing he said in the call should warrant a sell-off, in my opinion. They're giving you a dividend, which is an incentive to hold. And Google basically answered all the concerns the market had about AI and search. Last quarter, the biggest problem with Google was when they said to Sundar, hey, AI is going to kill your business. What are you going to do? He literally stuttered, right? He didn't have anything to say. This time, He was like, actually, AI is a catalyst for search. We're experimenting with new stuff. We're getting hundreds of millions of subscribers, trying generative AI. Like, he had answers ready to go, and he killed it on those answers. And that's why I think the market was rewarding him, as we see Google continue to go a bit higher right now here at that 178 level. We topped that at 183. We'll see if we can get back there. But that's where Google is right now. We've got Microsoft starting in just a little bit. Microsoft not having as great of a quarter, good quarter, not as great of stock performance. And that's also because Microsoft was at a 36 PE, Google was at a 28 PE. So obviously Microsoft was a bit more richly valued than Google. 3.9% up. So Microsoft, good quarter. The good thing is Snapchat's still 27%. Whether you're not in Google or Microsoft, maybe in Google or Microsoft, it's important that they performed really well. And that's what we got. Chris, we're going to listen to Microsoft, and I guess then we'll talk afterwards. Does that work? Okay, cool. So Microsoft will be starting in just a sec. Chris, while we're mating, while the music's starting, what's your initial raw reaction to Google?
Hold on 1 second.
Yeah, you're good.
So first and foremost, I just woke up. I was listening to the call in bed. Bro, I thought you could put it down a little bit.
Okay.
First of all, I just want to say and shout out to all the fucking Patreon crew, including yourself, who got into the 175, 225.
No. I sold my spreads. I thought you sold your spread. Dude, you sold your spreads too.
No, when it went down to 135, I was buying.
I don't have Google. I'm out. I'm out of Google.
Oh no. Oh no.
No, I put that shit into Robinhood. I'm out. I'm not.
All right, whatever, man. But shout out to all the fucking people on the Patreon who are absolutely fucking crushing it today. Congratulations. But Amit, there is one thing I just want to say. I think this trend is going to be unbroken for Google. All right, let's turn this back.
We'll talk after, guys. We got an hour, then we'll talk.
At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. I would now like to turn the conference over to your host, Brett Iverson, Vice President of Investor Relations.
Good afternoon, and thank you for joining us today. On the call with me are Satya Nadella, Chairman and Chief Executive Officer, Amy Hood, Chief Financial Officer, Alice Jalla, Chief Accounting Officer, and Keith Dolliver, Corporate Secretary and Deputy General Counsel. On the Microsoft Investor Relations website, you can find our earnings press release and financial summary slide deck, which is intended to supplement our prepared remarks during today's call and provides the reconciliation of differences between GAAP and non-GAAP financial measures. More detailed Outlook slides will be available on the Microsoft Investor Relations website when we provide Outlook commentary on today's call. On this call, we will discuss certain non-GAAP items. The non-GAAP financial measures provided should not be considered as a substitute for or superior to the measures of financial performance prepared in accordance with GAAP. They are included as additional clarifying items to aid investors in further understanding the company's third quarter performance, in addition to the impact these items and events have on the financial results. All growth comparisons we make on the call today relate to the corresponding period of last year unless otherwise noted. We will also provide growth rates in constant currency when available as a framework for assessing how our underlying businesses performed, excluding the effect of foreign currency rate fluctuations. Where growth rates are the same in constant currency, we'll refer to the growth rate only. We will post our prepared remarks to our website immediately following the call until the complete transcript is available. Today's call is being webcast live and recorded. If you ask a question, it will be included in our live transmission, in the transcript, and in any future use of the recording. You can replay the call and view the transcript on the Microsoft Investor Relations website. During this call, we'll be making forward-looking statements, which are predictions, projections, or other statements about future events. These statements are based on current expectations and assumptions that are subject to risks and uncertainties. Actual results could materially differ because of factors discussed in today's earnings press release, in the comments made during this conference call, and in the risk factors section of our Form 10-K, Forms 10-Q, and other reports and filings with the Securities and Exchange Commission. We do not undertake any duty to update any forward-looking statement. And with that, I'll turn the call over to Satya.
Thank you, Brett.
It was a record third quarter powered by the continued strength of Microsoft Cloud, which surpassed $35 billion in revenue, up 23%. Microsoft Copilot and Copilot Stack, spanning everyday productivity, business process, and developer services to models, data, and infrastructure, are orchestrating a new era of AI transformation, driving better business outcomes across every role and industry. Now I'll highlight examples walking up the stack, starting with AI infrastructure. Azure again took share as customers use our platforms and tools to build their own AI solutions. We offer the most diverse selection of AI accelerators, including the latest from NVIDIA, AMD, as well as our own first-party silicon. Our AI innovation continues to build on our strategic partnership with OpenAI. More than 65% of the Fortune 500 now use Azure OpenAI service. We also continue to innovate and partner broadly to bring customers the best selection of frontier models and open source models, LLMs and SLMs. With 5.3, which we announced earlier this week, we offer the most capable and cost-effective SLM available. It's already being trialed by companies like CallMiner, LTI, Mindtree, PwC, and TCS. Our Models as a Service offering makes it easy for developers to use LLMs and SLMs without having to manage any underlying infrastructure. Hundreds of paid customers from Accenture and EY to Schneider Electric are using it to take advantage of API access to third-party models, including, as of this quarter, the latest from Cohere, Meta, and Mistral. And as part of a partnership announced last week, G42 will run its AI applications and services on our cloud. All up, the number of Azure AI customers continues to grow and average spend continues to increase. We also saw an acceleration of revenue from migrations to Azure. Azure Arc continues to help customers like Dick's Sporting Goods and World Bank streamline their cloud migrations. Arc now has 33,000 customers, up over 2x year over year, and we are the hyperscale platform of choice for SAP and Oracle workloads, with Conduent and Medline moving their on-premise Oracle estates to Azure, and Kyndryl and L'Oreal migrating their SAP workloads to Azure. Overall, we are seeing an acceleration in the number of large Azure deals from leaders across industries, including billion-dollar-plus multi-year commitments announced this month from Cloud Software Group and the Coca-Cola Company. The number of $100 million-plus Azure deals increased over 80% year over year, while the number of $10 million-plus deals more than doubled. Now on to data and analytics. Our Microsoft Intelligent Data Platform provides customers with the broadest capabilities spanning databases, analytics, business intelligence, governance, and AI. Over half of our Azure AI customers also use our data and analytics tools. Customers are building intelligent applications running on Azure, PostgreSQL, and Cosmos DB with deep integrations with Azure AI. TomTom is a great example. They've used Cosmos DB along with Azure OpenAI Service to build their own immersive in-car infotainment system. We are also encouraged by our momentum with our next-generation analytics platform, Microsoft Fabric. Fabric now has over 11,000 paid customers, including leaders in every industry, from ABB, EDP, Energy Transfer to Equinor, Foot Locker, Itochu, and Lumen, and we are seeing increased usage intensity. Fabric is seamlessly integrated with Azure AI Studio, meaning customers can run models against enterprise data that's consolidated in Fabric's multi-cloud data lake, OneLake. And Power BI, which is also natively integrated with Fabric, provides business users with AI-powered insights. We now have over 350,000 paid customers. Now on to developers. GitHub Copilot is bending the productivity curve for developers. We now have 1.8 million paid subscribers, with growth accelerating to over 35% quarter over quarter, and continues to see increased adoption from businesses in every industry, including Itaú, Lufthansa Systems, Nokia, Pinterest, and Volvo Cars. Copilot is driving growth across the broader GitHub platform too. AT&T, Citigroup, and Honeywell all increased their overall GitHub usage after seeing productivity and code quality increases with Copilot. All up, more than 90% of the Fortune 100 are now GitHub customers, and revenue accelerated over 45% year over year. Anyone can be a developer with new AI-powered features across our low-code, no-code tools, which makes it easier to build an app, automate workflow, or create a copilot using natural language. 30,000 organizations across every industry have used Copilot Studio to customize Copilot for Microsoft 365 or build their own, up 175% quarter over quarter. Cineplex, for example, built a Copilot for customer service agents, reducing query handling time from as much as 15 minutes to 30 seconds. All up, over 330,000 organizations, including over half of Fortune 100, have used AI-powered capabilities in Power Platform, and Power Apps now has over 25 million monthly active users, up over 40% year over year. Now on to future of work. We are seeing AI democratize expertise across the workforce. What inventory turns are to efficiency of supply chains, knowledge turns, the creation and diffusion of knowledge are to productivity of an organization. And Copilot for Microsoft 365 is helping increase knowledge turns. That's having a cascading effect, changing work artifacts and workflows, and driving better decision-making, collaboration, and efficiency. This quarter, we made Copilot available to organizations of all types and sizes, from enterprises to small businesses. Nearly 60% of the Fortune 500 now use Copilot, and we have seen accelerated adoption across industries and geographies with companies like Amgen, BP, Cognizant, Koch Industries, Moody's, Novo Nordisk, NVIDIA, and Tech Mahindra purchasing over 10,000 seats. We're also seeing increased usage intensity from early adopters, including a nearly 50% increase in the number of Copilot-assisted interactions per user in Teams, bridging group activity with business process workflows and enterprise knowledge. And we're not stopping there. We're accelerating our innovation, adding over 150 Copilot capabilities since the start of the year. With Copilot in Dynamics 365, we're helping businesses transform every role and business function as we take share with our AI-powered apps across all categories. This quarter, we made our Copilot for Service and Copilot for Sales broadly available, helping customer service agents and sellers at companies like Land O'Lakes, Northern Trust, Rockwell Automation, and Toyota Group generate role-specific insights and recommendations from across Dynamics 365 and Microsoft 365, as well as third-party platforms like Salesforce, ServiceNow, and Zendesk. And with our Copilot for Finance, we are drawing context from Dynamics as well as ERP systems like SAP to reduce labor-intensive processes like collections and contract and invoice capture for companies like Dentsu and IDC. ISVs are also building their own Copilot integrations. For example, new integrations between Adobe Experience Cloud and Copilot will help marketeers access campaign insights in the flow of their work. When it comes to devices, Copilot in Windows is now available on nearly 225 million Windows 10 and Windows 11 PCs, up 2x quarter over quarter. With Copilot, we have an opportunity to create an entirely new category of devices purpose-built for this new generation of AI. All of our largest OEM partners have announced AI PCs in recent months, and this quarter we introduced new Surface devices, which includes integrated NPUs to power on-device AI experiences like auto-framing and live captions. And there's much more to come. In just a few weeks, we'll hold a special event to talk about our AI vision across Windows and devices. When it comes to Teams, we once again saw year-over-year usage growth. We're rolling out a new version, which is up to 2 times faster while using 50% less memory to all customers. We surpassed 1 million Teams rooms for the first time as we continue to make hybrid meetings better with new AI-powered features like automatic camera switching and speaker recognition. And Teams Phone continues to be the market leader in cloud calling, now with over 20 million PSTN users, up nearly 30% year over year. All of this innovation is driving growth across Microsoft 365 companies across the private and public sector, including Amadeus, BlackRock, Chevron, Ecolab, Kimberly-Clark, all chose our premium E5 offerings this quarter for advanced security, compliance, voice, and analytics. Now on to industry and cross-industry clouds. We're also bringing AI-powered transformation to every industry. In healthcare, DAX Copilot is being used by more than 200 healthcare organizations, including Providence, Stanford Healthcare, and WellSpan Health. And in manufacturing this week at Hanover Massey, customers like BMW, Siemens, and Volvo Penta shared how they're using our cloud and AI solutions to transform factory operations. Now on to security. Security underpins every layer of the tech stack, and it's our number one priority. We launched our Secure Future initiative last fall for this reason, bringing together every part of the company to advance cybersecurity protection, and we are doubling down on this very important work, putting security above all else, before all other features and investments. We are focused on making continuous progress across the 6 pillars of this initiative as we protect tenants and isolate production systems, protect identities and secrets, protect networks, protect engineering systems, monitor and detect threats, and accelerate responses and remediation. We remain committed to sharing our learnings, tools, and innovation with customers. A great example is Copilot for Security, which we made generally available earlier this month, bringing together LLMs with domain-specific skills informed by our threat intelligence and 78 trillion daily security signals to provide security teams with actionable insights. Now let me talk about our consumer businesses, starting with LinkedIn. We continue to combine our unique data with this new generation of AI to transform the way members learn, sell, and get hired. Features like LinkedIn AI-assisted messages are seeing a 40% higher acceptance rate and accepted over 10% faster by job seekers, saving hirers time and making it easier to connect them to candidates. Our AI-powered collaborative articles, which have reached over 12 million contributions, are helping increase engagement on the platform, which reached a new record this quarter. New AI features are also helping accelerate LinkedIn Premium growth, with revenue up 29% year over year. And we're also seeing strength across our other businesses, with hiring taking share for the 7th consecutive quarter. Now on to search advertising and news. We once again took share across Bing and Edge as we continue to apply this new generation of AI to transform how people search and browse. Bing reached over 140 million daily active users, and we are particularly encouraged by our momentum in mobile. Our free Copilot apps on iOS and Android saw a surge in downloads after our Super Bowl ad and are among the highest rated in this category. We also rolled out Copilot to our ad platform this quarter, helping marketeers use AI to generate recommendations for product images, headlines, and descriptions. Now on to gaming. We are committed to meeting players where they are by bringing great games to more people on more devices. We set third quarter records for game streaming hours, console usage, and monthly active devices. And last month, we added our first Activision Blizzard title, Diablo 4, to our Game Pass service. Subscribers played over 10 million hours within the first 10 days, making it one of our biggest first-party Game Pass launches ever. We were also encouraged by ongoing success of Call of Duty's Modern Warfare 3, which is attracting new gamers and retaining franchise loyalists. Finally, we are expanding our games to new platforms, bringing 4 of our fan-favorite titles to Nintendo Switch and Sony PlayStation for the first time. In fact, earlier this month, we had 7 games among the top 25 on the PlayStation Store, more than any other publisher. In closing, I'm energized about our opportunity ahead as we innovate to help people and businesses thrive in this new era. With that, let me turn it over to Amy.
Thank you, Satya, and good afternoon, everyone. Our third quarter revenue was $61.9 billion, up 17%, and earnings per share was $2.94, up 20%. Results exceeded expectations, and we delivered another quarter of double-digit top and bottom line growth, with continued share gains across many of our businesses. In our commercial business, bookings increased 29% and 31% in constant currency, significantly ahead of expectations, driven by Azure commitments with an increase in average deal size and deal length, as well as strong execution across our core annuity sales motions. In Microsoft 365, suite strength contributed to ARPU expansion for our Office commercial business, although new business growth continued to moderate for standalone products sold outside the Microsoft 365 suite. Commercial remaining performance obligation increased 20% and 21% in constant currency to $235 billion. Roughly 45% will be recognized in revenue in the next 12 months, up 20% year over year. The remaining portion, recognized beyond the next 12 months, increased 21%. And this quarter, our annuity mix increased to 97%. In our consumer business, PC market demand was slightly better than we expected, benefiting Windows OEM, while advertising spend landed relatively in line with our expectations. In gaming, we also saw better than expected performance of Activision titles, benefiting Xbox content and services. At a company level, Activision contributed a net impact of approximately 4 points to revenue growth, was a 2-point drag on operating income growth, and had a negative 4-cent impact to earnings per share. A reminder that this net impact includes adjusting for the movement of Activision content from our prior relationship as a third-party partner to first party, and also includes $935 million from purchase accounting adjustments, integration, and transaction-related cost. FX did not have a significant impact on our results and was roughly in line with our expectations on total company revenue, segment-level revenue, COGS, and operating expense growth. Microsoft Cloud revenue was $35.1 billion and grew 23%, ahead of expectations. Microsoft Cloud gross margin percentage decreased slightly year over year to 72%, a bit better than expected. Excluding the impact of the change in accounting estimate for useful lives, gross margin percentage increased slightly, driven by improvement in Azure and Office 365, even with the impact of scaling our AI infrastructure, partially offset by sales mix shift to Azure. Company gross margin dollars increased 18% and gross margin percentage increased slightly year over year to 70%. Excluding the impact of the change in accounting estimate, gross margin percentage increased roughly 1 point, even with the impact from the purchase accounting adjustments, integration, and transaction-related costs from the Activision acquisition. Growth was driven by the improvement in Azure and Office 365 just mentioned, as well as sales mix shift to higher margin businesses. Operating expenses increased 10% with 9 points from the Activision acquisition. At a total company level, headcount at the end of March was 1% lower than a year ago. Operating income increased 23% and operating margins increased roughly 2 points year over year to 45%. Excluding the impact of the change in accounting estimate, operating margins increased roughly 3 points, driven by the higher gross margin noted earlier and improved operating leverage through continued cost discipline. Now to our segment results. Revenue from productivity and business processes was $19.6 billion and grew 12% and 11% in constant currency, in line with expectations. Office commercial revenue grew 13% and 12% in constant currency. Office 365 commercial revenue increased 15%, in line with expectations, driven by healthy renewal execution, ARPU growth from continued E5 momentum, and early Copilot for Microsoft 365 progress. Paid Office 365 commercial seats grew 8% year over year, with installed base expansion across all customer segments. Seat growth was again driven by our small and medium business and frontline worker offerings, although growth continued to moderate in SMB. Office commercial licensing declined 20% and 18% in constant currency, with continued customer shift to cloud offerings. Office consumer revenue increased 4%, slightly below expectations. Microsoft 365 subscriptions grew 14% to 80.8 million. LinkedIn revenue increased 10% and 9% in constant currency, ahead of expectations, driven by slightly better than expected performance in our premium subscriptions and Talent Solutions businesses. However, in Talent Solutions, bookings growth continues to be impacted by the weaker hiring environment in key verticals. Dynamics revenue grew 19% and 17% in constant currency, ahead of expectations. Growth was driven by Dynamics 365, which grew 23% and 22% in constant currency, with continued growth across all workloads, and better than expected new business, although bookings growth remains moderated. Segment gross margin dollars increased 11%, and gross margin percentage decreased slightly year over year. Excluding the impact of the change in accounting estimate, gross margin percentage increased slightly, driven by improvement in Office 365. Operating expenses increased 1%, and operating income increased 17% and 16% in constant currency. Next, the Intelligent Cloud segment. Revenue was $26.7 billion, increasing 21%. Ahead of expectations with better than expected results across all businesses. Overall, server products and cloud services revenue grew 24%. Azure and other cloud services revenue grew 31%, ahead of expectations, while our AI services contributed 7 points of growth as expected. In the non-AI portion of our consumption business, we saw greater than expected demand broadly across industries and customer segments, as well as some benefit from a greater than expected mix of contracts with higher in-period recognition. In our per-user business, the enterprise mobility and security install base grew 10% to over 274 million seats, with continued impact from the growth trends in new standalone business noted earlier. In our on-premises server business, revenue increased 6%, ahead of expectations, driven by better than expected renewal strength, particularly for contracts with higher in-period revenue recognition. Enterprise and partner services revenue decreased 9% on a strong prior year comparable for enterprise support services. Segment gross margin dollars increased 20% and gross margin percentage decreased slightly year over year. Excluding the impact of the change in accounting estimate, percentage increased slightly, primarily driven by the improvement in Azure noted earlier, even with the impact of scaling our AI infrastructure, partially offset by sales mix shift to Azure. Operating expenses increased 1% and operating income grew 32%. Now to more personal computing. Revenue was $15.6 billion, increasing 17%, with 15 points of net impact from the Activision acquisition. Results were above expectations, driven by better than expected performance in gaming and Windows OEM. Windows OEM revenue increased 11% year over year, ahead of expectations, primarily driven by the slightly better PC market noted earlier, as well as mix shift to higher monetizing markets. Windows commercial products and cloud services revenue increased 13% and 12% in constant currency, below expectations, with impact from the growth trends in new standalone business noted earlier, as well as lower in-period revenue recognition from a mix of contracts. Devices revenue decreased 17% and 16% in constant currency as we remained focused on our higher margin premium products. Overall, Surface demand was slightly lower than expected. Search and news advertising revenue ex-TAC increased 12%, ahead of expectations, with continued volume growth and increased engagement on Bing and Edge. And in gaming, revenue increased 51% and 50% in constant currency, with 55 points of net impact from the Activision acquisition. Results were ahead of expectations, primarily driven by Call of Duty. Xbox content and services revenue increased 62% and 61% in constant currency, with 61 points of net impact from the Activision acquisition. Xbox hardware revenue decreased 31% and 30% in constant currency. Segment gross margin dollars increased 27% and 26% in constant currency, with 13 points of net impact from the Activision acquisition. Gross margin percentage increased roughly 4 points year over year, primarily driven by sales mix shift to higher margin businesses. Operating expenses increased 41%, with 43 points from the Activision acquisition. Operating income increased 16% and 15% in constant currency. Now, back to total company results. Capital expenditures, including finance leases, were $14 billion to support our cloud demand, inclusive of the need to scale our AI infrastructure. Cash paid for PP&E was $11 billion. Cash flow from operations was $31.9 billion, up 31%, driven by strong cloud billings and collections. Free cash flow was $21 billion, up 18% year over year, reflecting higher capital expenditures to support our cloud and AI offerings. This quarter, other income and expense was negative $854 million, lower than anticipated, driven by losses on investments accounted for under the equity method. Our effective tax rate was approximately 18%. And finally, we returned $8.4 billion to shareholders through dividends and share repurchases. Now, moving to our Q4 outlook, which, unless specifically noted otherwise, is on a U.S. dollar basis. First, FX. Based on current rates, which reflect the recent strengthening of the U.S. dollar, we now expect FX to decrease total revenue and segment-level revenue growth by less than 1 point. When compared to our January guide for Q4 FX, this is a decrease to total revenue of roughly $700 million. We expect FX to decrease COGS growth by approximately 1 point and operating expense growth by less than 1 point. In commercial bookings, we expect solid growth on a relatively flat expiry base, driven by continued strong commercial sales execution. As a reminder, larger long-term Azure contracts, which are more unpredictable in their timing, can drive increased quarterly volatility in our bookings growth rate. Microsoft Cloud gross margin percentage should decrease roughly 2 points year over year. Excluding the impact from the change in accounting estimate, Q4 cloud gross margin percentage will be down slightly, as improvement in Azure, inclusive of scaling our AI infrastructure, will be offset by sales mix shift to Azure. We expect capital expenditures to increase materially on a sequential basis, driven by cloud and AI infrastructure investments. As a reminder, there can be normal quarterly spend variability in the timing of our cloud infrastructure buildouts and the timing of finance leases. We continue to bring capacity online as we scale our AI investments with growing demand. Currently, near-term AI demand is a bit higher than our available capacity. Next, to segment guidance. In productivity and business processes, we expect revenue to grow between 9 and 11% in constant currency, or $19.9 to $20.2 billion US. In Office Commercial, revenue growth will again be driven by Office 365 with seat growth across customer segments and ARPU growth primarily through E5. We expect Office 365 revenue growth to be approximately 14% in constant currency. We continue to progress with adoption of Copilot for Microsoft 365 and remain excited for the long-term growth opportunity. In our on-premises business, we expect revenue to decline in the mid to high teens. In Office Consumer, we expect revenue growth in the low to mid-single digits, driven by Microsoft 365 subscriptions. For LinkedIn, we expect revenue growth in the mid to high single digits, driven by continued growth across all businesses. And in Dynamics, we expect revenue growth in the low to mid-teens, driven by Dynamics 365. For both LinkedIn and Dynamics, the continued bookings growth moderation noted earlier is a headwind to Q4 revenue growth. For Intelligent Cloud, we expect revenue to grow between 19 and 20% in constant currency, or $28.4 to $28.7 billion US. Revenue will continue to be driven by Azure, which, as a reminder, can have quarterly variability primarily from our per-user business and in-period revenue recognition, depending on the mix of contracts. In Azure, we expect Q4 revenue growth to be 30 to 31% in constant currency, or similar to our stronger than expected Q3 results. Growth will be driven by our Azure consumption business and continued contribution from AI, with some impact from the AI capacity availability noted earlier. Our per-user business should see benefit from Microsoft 365 suite momentum, though we expect continued moderation in seat growth rates given the size of the installed base. In our on-premises server business, we expect revenue growth in the low to mid-single digits with continued hybrid demand, including licenses running in multi-cloud environments. And in enterprise and partner services, revenue should decline in the mid to high single digits on a high prior year comparable for enterprise support services. In more personal computing, we expect revenue to grow between 10 and 13% in constant currency, or $15.2 to $15.6 billion US. Windows OEM revenue growth should be in the low to mid-single digits as PC market unit volumes continue at pre-pandemic levels. In Windows commercial products and cloud services, customer demand for Microsoft 365 and our advanced security solutions should drive revenue growth in the mid-single digits. As a reminder, our quarterly revenue growth can have variability primarily from in-period revenue recognition, depending on the mix of contracts. In devices, revenue should decline in the mid-teens as we continue to focus on our higher margin premium products. Search and news advertising ex-TAC revenue growth should be in the low to mid-teens, driven by continued volume strength. This will be higher than overall search and news advertising revenue growth, which we expect to be relatively flat. And in gaming, we expect revenue growth in the low to mid-40s, including approximately 50 points of net impact from the Activision acquisition. We expect Xbox content and services revenue growth in the high 50s, driven by approximately 60 points of net impact from the Activision acquisition. Hardware revenue will decline again year over year. Now, back to company guidance. We expect COGS between $19.6 to $19.8 billion US, including approximately $700 million from purchase accounting, integration, and transaction-related costs from the Activision acquisition. We expect operating expense of $17.15 to $17.25 billion, including approximately $300 million from purchase accounting, integration, and transaction-related costs from the Activision acquisition. Therefore, we now expect full-year FY24 operating margins to be up over 2 points year over year, even with our cloud and AI investments, the impact from the Activision acquisition, and the headwind from the change in useful lives last year. This operating margin expansion reflects the hard work across every team to drive efficiencies and maintain disciplined cost management, knowing we will continue to grow our cloud and AI investments next year. Other income and expense should be roughly negative $850 million, as interest income will be more than offset by interest expense and losses on investments accounted for under the equity method. As a reminder, we are required to recognize gains or losses on our equity investments, which can increase quarterly volatility. We expect our Q4 effective tax rate to be approximately 18%. Now, I'd like to share some closing thoughts as we look to the next fiscal year. We continue to focus on building businesses that create meaningful value for our customers and therefore significant growth opportunities for years to come. In FY25, that focus and execution should again lead to double-digit revenue and operating income growth. To scale to meet the growing demand signal for our cloud and AI products, we expect FY25 capital expenditures to be higher than FY24. These expenditures over the course of the next year are dependent on demand signals and adoption of our services, so we will manage that signal through the year. We will also continue to prioritize operating leverage, and therefore, we expect FY25 operating margins to be down only about 1 point year over year, even with our significant cloud and AI investments, as well as a full year of impact from the Activision acquisition. We are leading the AI platform wave and are committed to bringing that value to our global customers as we enter the final quarter of our fiscal year. With that, let's go to Q&A, Brett.
Thanks, Amy. We'll now move over to Q&A. Out of respect for others on the call, we request that participants please only ask one question. Operator, can you please repeat your instructions?
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue.
All right, Q&A.
For participants using speaker equipment,
That's what we're waiting for.
It may be necessary to pick up your handset before pressing the star keys.
Microsoft's up 5%. Here we go.
And our first question comes from the line of Keith Weiss with Morgan Stanley. Please proceed.
Excellent. Thank you guys for taking the question, and congratulations on a fantastic quarter. A lot of excitement in the marketplace around generative AI and the potential of these technologies, but there's also a lot of investment going on behind them. It looks like Microsoft's on track to ramp CapEx over 50% year on year this year to over $50 billion. And there's media speculation of more spending ahead, with some reports talking about like $100 billion data center. So obviously investments are coming well ahead of the revenue contribution. But what I was hoping for is that you could give us some color on how you as the management team try to quantify the potential opportunities that underlie these investments, because they are getting very big. And maybe if you give us some hints on whether there's any truth to the potential of like $100 billion data center out there. Thank you so much.
Thank you, Keith, for the question. Let me start, and then maybe you can feel free to add. At a high level, the way we, as a management team, talk about it is there are two sides to this, right? There is training and there's inference. Given that we want to be a leader in this big generational shift and paradigm shift in technology, that's on the training side. We want to be able to allocate the capital required to essentially be training these large foundation models and stay on the leadership position there. And we've done that successfully all the way today, and you've seen it flow through our P&L, and you can continue to see that going forward. Then Amy referenced what we also do on the inference side, which is one, we first innovate and build products. And of course, we have an infrastructure business that's also dependent on a lot of ISVs building products that run on our infrastructure. And it's all going to be demand driven. In other words, we track very closely what's happening with inference demand. and that's something that we'll manage, as Amy said in her remarks, very, very closely. So we feel, and obviously we've been doing this, quite frankly, Keith, for now multiple years. So this is not the quarter. I realize in the news it's a lot more in the quarter nowadays, but if you look at it, we've been doing what is essentially capital allocation to be a leader in AI for multiple years now, and we plan to sort of essentially keep taking that forward.
And Keith, I do think it's important to really think about our planning cycles, and we do talk about spending sequentially higher, and we look forward to being able to continue to build out the infrastructure needed to meet the demand. Another thing that you really asked in the beginning was the opportunity and the size of that. And I think in some ways, it's important to think about every business process that can be impacted and the opportunity that's represented by every business process. And so when you think of it that way, I think the opportunity is significant. The opportunity to power that next wave of quote unquote cloud infrastructure is important. It's important because we've been the leader through this decade of the cloud transition, and it's important for us to confidently invest to do that in the second wave, building on our success in the first. And I think that's really the best way to think about how we'll spend, is the same way we approached it for a decade. Watch the signal, invest to be a leader in the technical foundation, and then execute consistently to add value to customers. The opportunity is represented by the amount of value we add. And I look forward to being able to continue to deliver that.
Excellent. Thank you so much.
Thanks, Keith. Operator, next question, please.
The next question comes from the line of Brent Thill with Jefferies. Please proceed.
Satya, how would you characterize the demand environment? On one hand, you have bookings and Azure both accelerating year over year in the quarter, but we're seeing a lot of future concern and hesitation from other vendors we all cover. So I think everyone would love to get your sense of budget health for customers this year.
A great question, Brent. There are a couple of things I would say on the Azure side, which I think is what you specifically asked. We feel very, very good about we're fundamentally a share taker there, because if you look at it from our perspective at this point, Azure has become a port of call for pretty much anybody who is doing any AI project, and so that's sort of been a significant help for us in terms of acquiring even new customers. Some of the logos I even referenced in my remarks are new Azure customers. So that's one. The second thing that we're also seeing is AI just doesn't sit on its own. So AI projects obviously start with calls to AI models, but they also use a vector database. In fact, Azure Search, which is really used by even ChatGPT, is one of the fastest growing services for us. We have Fabric integration to Azure AI, and so Cosmos DB integration. So the data tier, the dev tools is another place where we are seeing great attraction. So we are seeing adjacent services in Azure that get attached to AI. And lastly, I would say migrations to Azure as well. So this is not just all an AI story. We are also looking at customers. I mean, this is something that we have talked about in the past, right? Which is, there's always an optimization cycle, but there's also, as people optimize, they spend money on new project starts, which will grow, and then they'll optimize. So it's a continuous side of it. So these are the three trends that are playing out on Azure in terms of what at least we see on demand side.
Thank you.
Thanks, Brent. Operator, next question, please.
And the next question comes from the line of Mark Moerdler with Bernstein Research. Please proceed.
Thank you very much for taking my question, and congratulations on the quarter and the guidance. I want to follow up on the AI, obviously. We're seeing companies shifting their IT spending to invest in and learn about AI rather than receiving additional budgets for AI. At some point, for AI to be transformative, as everyone expects, it needs to be accretive to spending. Satya, when do you believe AI will hit the maturity level where it'll be net increase to IT or outside of IT spending? And what would be the leading indicators of that maturation? And Amy, am I characterizing this correctly as it relates to Azure? Some projects are being delayed so that spending could be shifted from core Azure toward Azure AI. Thank you.
Yeah, great set of questions, Mark. Let me just start by saying, a good place to start is to watch what's happening in terms of standard issues for software teams, right? I mean, if you think about it, they bought tools in the past. Now you basically buy tools plus Copilot, right? So you could even say that this is characterized as perhaps shift of what is OpEx dollars into effectively tool spend, because it gives operating leverage to all of the OpEx dollars you're spending today, right? That's really a good example of, I think, what's going to happen across the board. We see that in customer service, we see that in sales, we see that in marketing, anywhere there's operation. That's why I described it as, knowledge turns. You can even think of it as lean for knowledge work, right? So because it just reduces waste, increases speed, and customer value. And so one of the interesting rate limiters here is culture change inside of organizations. When I say culture change, that means process change. And Amy referenced this even in her answer to the first question, because at the end of the day, companies will have to take a process, simplify the process, automate the process, and apply these solutions. And so that requires not just technology, but in fact, companies to go do the hard work of culturally changing how they adopt technology to drive that operating leverage. And this is where we're going to see firm level performance differences. So one of the things we see is any customer who is working closely with us, deploying it internally at Microsoft, we see it, right? We're also taking our own medicine to apply this across every process. And we know that this is not just about technology, it's about being able to have the methodology that goes with it. And so we see it in software development, we see it in customer service, we're seeing it even in the horizontal use of Copilot today, where every day people are discovering new workflows that they can optimize. And so that's like the PC when it became standard issue in the early 90s. That's the closest analogy I can come up with. And so yes, it'll take time for it to percolate through the economy, but this is faster diffusion, faster rate of adoption than anything we have seen in the past, as evidenced even by Copilot, right? It's faster than any suite we have sold in the past. But it is going to require workflow and process change.
And Mark, maybe to answer your question on, are we seeing project starts transition from maybe something that was core consumption to an AI project? In our results, that's not what we saw. We saw more what Satya was speaking to earlier, which is you see maybe growth in migrations again. You're seeing work in the data space again, and you're seeing AI project starts. And I think that's why maybe you see our growth be different, of course, than you see IT budget spend. It's because it's a share, I think, improvement, plus also really focusing on what Satya said. It's about spending maybe in other areas that we don't traditionally think of as being in the IT budget spend under a CIO. It's spend being done by the head of customer service. It's spend being done by the head of marketing. And I do think that will be important as we think about the opportunity ahead.
Incredibly helpful. Thank you both.
Thanks, Mark. Operator, next question, please.
The next question comes from the line of Karl Keirstead with UBS. Please proceed.
Thank you. And Satya and Amy, congrats on these outstanding Azure results. I'd love to hone in a little bit on the 7-point lift to Azure growth from AI. Outstanding number, but it's leveling off a little bit from 6 points in December. I'm wondering if you could unpack that a little bit. To what extent did the capacity issues that you, Amy, highlighted on the call impact that number? Is there any seasonality? I wouldn't think so. Or any other factor that can swing around that number that you'd advise us to keep in mind? Thanks so much.
Thanks, Karl. There's not a seasonality to the number, so you're absolutely right to start there, and it's a good question. The way to think about it is a bit more how much capacity we have in play and how much capacity that we have to sell on the inferencing side in particular. And so that is partially why you see the capital investment in the shape that it is because right this minute we do have demand that exceeds our supply by a bit. So it is fair to say that that could have been an impact on the number for the quarter and does impact a little bit the number in Q4.
Okay, helpful. Thank you.
Thanks, Carl. Operator, next question, please.
And the next question comes from the line of Raimo Lenschow with Barclays. Please proceed.
Thank you. I have more a conceptual question for Satya. If you think about Copilot and what you're doing there, you're kind of impacting a lot of different businesses and the opportunities seem very broad-based. How do you think this will play out in the industry between you guys offering certain Copilots versus like the rest of the industry following and everyone seems to have a Copilot now and seems to be talking about it? How does that impact what you want to do, your partner strategy going forward? Thank you.
Yeah, it's a great question. So the way we see it play out is, if you think about it, the way Office was used broadly for knowledge work was in the context of business processes, right? So it's not like when people do knowledge work, they're not doing knowledge work. They're doing knowledge work in support of making progress in the context of sales enablement, customer service, revenue ops, supply chain, or what have you, right? So that's the first thing to know. And they do it inside of email. They do it inside of Teams. They do it inside of Excel, PowerPoint, Word, and what have you. Now we have the ability to essentially bridge the work and the work artifacts inside of these knowledge worker tools with the workflow and the business process and the business process data. So when we think about our Copilot has that ability to integrate, whether it's with ServiceNow, where it has the ability to integrate with SAP, with Salesforce, with obviously Dynamics. That's what we are seeing. In fact, you'll hear us talk a lot about it at our developer conference, which is the extensibility. And Copilot Studio is, it's really off to the races in terms of the product, and most people are excited because one of the things in the enterprise is you want to ground your Copilot with enterprise data, which is in all of these SaaS applications, and Copilot Studio is the tool to use it to make that happen. And so that's what we're seeing, which is we are building a Copilot, which also happens to be an orchestrator of all these other Copilots, which to us appear as extensions. And net, what happens is some of these knowledge worker tools that people have used all the time, right? Because when you think about Teams, when you're having a meeting, you're not doing a random meeting. The meeting is in the context of some business process. It could be a supply chain, meeting where you're trying to understand which suppliers to bet on or what terms to do. And so now you can access all of that data right in the Teams context. So that's, I think, what's exciting for us, having built all these horizontal tools, which I would say were underappreciated for the amount of work how people use those tools to make progress on business process, but we now get to bridge that between the business applications and knowledge worker tools more horizontally.
Okay, perfect. Thank you. Congrats from me as well.
Thanks, Raimo. Operator, next question, please.
And the next question comes from the line of Michael Turrin with Wells Fargo. Please proceed.
Hey, great. Appreciate you taking the question. I wanted to go back to Azure. You've been hinting at stabilization there for the past couple of quarters, but still very good to see the bounce. Maybe you can expand on just what the commercial bookings number, appreciating the variability there, does in terms of visibility, and any characterization you can give us around what you're seeing in areas like cost optimization and core workload growth coming back is just helpful context for us in unpacking the numbers. Thank you.
Thanks, Michael. I may take those a bit in reverse. It's a little easier to address them. When you think about, we've been talking about sort of stabilization and what you saw this quarter, if you break down the Azure number, as you saw, which I think I talked a little bit about with Carl, was 7 points of contribution from AI, and you could call then the difference 24 from our core really Azure business. And within that, the activity we saw on the consumption side was really this balance that we were quite used to and have seen throughout the cloud transition. We saw new workload starts and we saw optimizations. And then those optimizations create new budget and you apply it. And that cycle, which is actually quite normal, we saw it again this quarter in a balanced way. And I think so when we talk about stabilization, or even what we saw between Q2 and Q3, which is a bit of acceleration in that core, was a lot of the newer project starts relating back to not just AI starts, but lots of other workflows that companies are still going from on-prem to cloud. That's why Satya mentioned migrations. And some of that, which I know isn't as exciting as talking about all the AI projects, this is still really foundational work to allow companies to take advantage of the cost savings. And the total TCO is still really good. And so I think that balance is really what you saw this quarter. And I feel like there wasn't really a big difference, Michael, across industries or across geos. So I would say it was actually pretty consistent, is the other maybe texture that I could give you to that question. And so then when you're saying, do we keep sort of pointing to stabilization? I really do look sort of workload to workload. What are we seeing? Where are starts? And this one actually felt quite balanced, and optimizations looked like they normally would, which, by the way, is super important. It's something we encourage customers to do. You want to run your workloads as efficiently as you possibly can. It's critical to customers being able to grow and get value out of that. So I sometimes think you all may ask the question more as a negative, and for us, it's just about a healthy cycle at the customer account level.
Now, consistent core cloud growth is still pretty exciting to us as well. Thank you.
Thank you.
Thanks, Michael. Operator, next question, please.
The next question comes from the line of Kirk Materne with Evercore ISI. Please proceed.
Yes, thanks for taking the question. I'll add my congrats on the quarter. Satya, I was wondering if you could chime in on a discussion that comes up a lot with investors, which is, is there a sort of data quality problem in the market in terms of being able to take advantage of all these new Gen AI capabilities? And I was just curious if you could comment on, do you see companies making inroads on sort of addressing that? And do you see that as sort of an inhibitor to AI growth at all at this point? Thanks.
Yeah, it's a great question, because there are two sets of things in order to make sense of successful deployment of these new AI capabilities. I mean, if you sort of say this, what is this AI? It does two things, right? There's a new user experience, there's a natural language interface, and second thing is it's a reasoning engine. And the reasoning engine requires good data, and requires good data for grounding, right? So people talk about something called retrieval augmented generation. And in that context, having good grounding data that then helps with the reasoning, I think, is helpful. And then, of course, people are also looking to sort of fine tune or RLHF or essentially take the large model and ground it further. So all of these tools are now available. The sophistication of how people can deploy these models across various business processes, where there is data and where there is tuning of these models, is also getting more widespread. Even as system integrators and other developers are there to help enterprises. So all that's maturing. So we feel good. And this is where I think on the commercial side, these are some of the harder problems to solve, broad consumer, right? I mean, I think this is a couple of orders of magnitude of improvements in, I'll call it, our models before we can sort of have more sophisticated, open-ended consumer scenarios. Whereas in the enterprise, these are all things we can go tackle. Again, I point to GitHub. If you think about how it's got an entire system, right? It's just not an AI model. It's the AI or the user experience scaffolding, the editor, the chat, the interpreter, and the debugger work along with the continuations of the model to help essentially create these reasoning traces which help the entire thing work. And effectively, what we are doing with Copilot, Copilot Studio, and connectors to all these business systems, think of it as we are creating GitHub Copilot-like scenarios for every business system. That's what I think is going to have both what Amy referenced as business value and better grounding. But you're absolutely right in saying a lot of work we're doing with Fabric or Cosmos or Postgres or SQL is about preparing that data so that it can be integrated with these AI projects.
Thank you. Thanks, Kurt. Operator, we have time for one last question.
And our last question will come from the line of Alex Zukin with Wolfe Research. Please proceed.
Hey guys, thanks for taking the question. I wanted to ask the AI question, but from a Microsoft 365 Copilot perspective. I think you talked a little bit about starting to see some of those impacts positively in the quarter on the Office business. I wanted to ask more broadly around that capacity constraint that you alluded to in your prepared remarks, Amy, and kind of how does the easing, how tight are we, like, as you invest for that CapEx and bring more of the capacity online, how much does that unblock or unlock the ability to deliver both a higher Azure AI number as well as a higher Microsoft 365 Copilot number?
Thanks for the question. It's a good opportunity to clarify. I would not say that there is a capacity constraint on the Copilot. It's a real priority for us to make sure we optimize the allocation of our capacity to make sure that those per user businesses are able to continue to grow. And so think about that as our priority one. And so then what that does mean is capacity constraints, when we have them, you'll tend to see them on the Azure infrastructure side, the consumption side of the business is a better way of thinking about it.
Perfect. Thank you.
Thanks, Alex. That wraps up the Q&A portion of today's earnings call. Thank you for joining us today, and we look forward to speaking with all of you soon.
Thank you all.
Thank you.
This concludes today's conference. You may now.
Oh boy. All right. Thank you for the people that are still here. Chris and I, we have Finance Junkies at 9. So Chris and I probably stay on for like 15, 20 minutes and just break down everything we heard from both of those calls. Before we get into it, Chris, thanks for joining. We've got Microsoft up 4.76% right now. And Google up 11.2%. At one point, Google was up 16%. Right now, Google at 175. Still an incredible quarter by both of them. Chris, let's start with Google, then we'll go to Microsoft. What are your raw thoughts on this one?
I think a couple of things. Number one, we are in the early innings of what's likely to be at least another few years of AI. The thing is, though, now we have to find, remember this is the discussion we had a little while ago. Who is ultimately going to be the value, the people who are going to be able to capture most of the value from this AI transition, right? So I think a lot of times people, they tend to focus like, oh, AI. And so you have all these like little weeds pop out of nowhere and then call themselves, oh, I'm SoundCloud AI, or I'm blah, blah, blah AI, and basically they take up all the attention. And yet at the end of the day, they don't actually produce any real value for shareholders, right? Normally the big guys are usually slow to move. They're just very like antiquated with the way that things are, and they're very slow to really adopt new technology. The good thing here is that there is a huge moat when it comes to AI in what it requires to get to the point where you actually have real value generation. So right now, I see Google, I see Microsoft, I see Amazon, Meta. Dude, these are the 4 companies that are still going to have the next 3 years of growth when it comes to AI. The rest of them can be a hodgepodge of little things here and there. But for the most part, if you're looking for the real value that's going to be generated, the real value is going to come from additional compute that's now going to be based on AI workloads. Where's that going to go to? That's ultimately going to be the toll bridge that's going to be paid. And the toll bridges are all owned by Microsoft, Google, Amazon, and Meta at this point, right? Meta a little less so because they're more into application, whereas these guys are more infrastructure providers. But So that's one thing. The other thing is, let's say we do get a recessionary headwind, right?
Yeah.
Which companies do you want to be in? Do you want to be in companies that have kind of like dodgy growth prospects, or do you want to be in more strategically placed, great companies, great cash flows that are buying back their shares? So normally what happens is people back in the day, they would transition away from growth companies and they would transition into value companies, right? So you would sell your growthy tech stocks and you would buy instead your value stocks like Verizon and Hershey's and everything else, which are, which is like, hey, look, they have reoccurring revenue that's not going anywhere. People are always going to be consuming, we call it telecommunication services. But this is a little bit of a paradigm shift in that I would say Google, Microsoft, Amazon, and Meta, even at their high PEs, they are still going to be the security. That is what people are kind of like, it's built into people's brains now. That if you want to secure your money, if you want to be in a secure place in the market, which other industry is going to give you this level of cash return, this level of growth, right? And I don't see it anywhere else but the Mag 7. So even if the Mag 7 right now, the valuations, especially for some of Microsoft, can be feel a little bit stretched, I think Google itself is still very undervalued for where it's supposed to end up. And dude, just one quick thing. Shout out to the Patreon crew, bro. They are doing absolutely freaking gangbusters on Google. So just shout out to all you guys who are holding Google right now. So right now, I would say.
What did you think about Sundar and the call and his answers around search and AI? Because the biggest concern is ChatGPT is going to kill the business. Do you think that's still a concern for people?
No, I don't think that's really a big concern anymore. I told you the real value generation isn't replacing necessarily search. Like that's not the way that I would phrase this. I think this is more like enhancing what already exists. The other thing is, even with ChatGPT and all these other things, can you honestly say that you're using Google less? Because I'm still using Google products all day, every day, right?
Yeah.
So I do think that this is one of those companies that, believe it, and here's the other thing that may not resonate with people. Even after this rise in Google, they are still only about 10% from their all-time highs. They're not like, oh my God, huge value generation since their all-time highs.
Yeah.
They're literally just got back to their all-time highs and now a little bit in excess of it. So I think there's still a lot of room left for Google to grow into, especially with the amount of cash flow they generate, the amount of share buybacks they're doing. So Google, I think, is a no-brainer going forward. The one thing I will say is, do not undercut Snowflake. I think Snowflake is this sleeper stock right now that is going to be just an absolute freaking killer as we transition from machine learning to inferencing. And you're going to see that. You're going to see a lot of this stuff come about. This new CEO, like I said, he is a products-oriented guy. He's really putting in the work to get products to market. And I think with all the guidance and expectations that have been basically decimated and lowered to no extent, I think right now you're going to see this huge wave of increase in demand going forward for Snowflake's workload services, especially once AI becomes more available. So right now they're doing everything. Snowflake is doing everything right to really penetrate the well, not just penetrate, but basically provide value to its enterprise clients. And the minute that they provide more value, that means that enterprise clients will spend more money, which means revenue, which means that Snowflake will get more money in terms of credits. And their growth rate is going to be in excess of what's currently projected, which is 20%, 30, like 20 something percent is what they guided for. Dude, these guys are going to crush it and crush it hard. So I'd say right now, Snowflake is the one you want to be in, man.
Okay, let's talk about Microsoft. You just heard the call with me. Anything exciting there outside of cloud growth, or what do you think?
They're just a beast, man. Microsoft is just a goddamn beast. There's no denying. They have so many. They've got so many tentacles in so many industries. They're just. How can you ever replace Microsoft at this point?
Yeah, I feel the same with Google. Same with Google, right?
Like, these are companies that are so entrenched into our daily lives that the only way that you could sync Google, Microsoft, Amazon, and Meta, there's only and Apple, there's only one way, and that's legislation. That's it. There's nothing else that like these motherfuckers are the Standard Oil of the 1900s at this point. They control everything. Now, the thing is it something that I like that they control everything as long as they don't necessarily interfere in the day-to-day operations of people? No. But we do have to say one thing though. This TikTok ban is going to go through. By the way, I don't know if you saw the news on what they said. They said we would rather shut TikTok down than sell it.
Yeah.
This was like music to Sundar's ears, music to Zuckerberg's ear. Because at the end of the day, who does it benefit? It benefits YouTube. And
it's going to happen soon, because if you're a creator with your whole business on TikTok and you know it's getting banned in 12 months, you have to move to YouTube immediately.
Yes, immediately. Yep.
Yeah, that's a good point, dude. That's a good point.
So the thing is, like, if you're going to do long form video, I don't know if TikTok really does long form video that well, but Instagram definitely does. But the thing that Google really has is the monetization aspect that makes them a little bit better than Instagram, right? The only thing I'll say is I think Google really needs to step up investing in their fucking shorts, bro. If shorts is still garbage, I'll be honest. I like shorts. I still catch myself watching some shorts here and there, but it is garbage compared to the algorithm that I get from Instagram. Like my wife sends me Instagram shit all the time. Google, not so much. So there is an aspect to Instagram that is likely to be a bigger beneficiary than Google is. But still,
look at this
I think
dude on Instagram. We got an ASMR massage, dude. Like ASMR massage, dude. It's good.
Wait, who is that? Who's massaging you? I
don't know. It's some random girl, but like the massage. Look at that. You wouldn't want that right now. Look at that's like. YouTube can't do that. Let me go to YouTube Shorts. YouTube Shorts going to say some stupid shit. Hold on. Let's just test.
Let me tell you. You know what
Look at this. Why do I want to see this? I don't want to see this guy.
Yeah.
You think I want an ASMR massage or this guy doing jumping jacks?
You want to know the ASMR? Well, it wasn't called ASMR, but it's like, these weird like loopholes that you get into, these vacuumous loopholes that you just start watching and then it becomes a part. So I now have gotten into this new genre of people going to random people's homes and cleaning up their lawns.
Oh,
I don't know if that's
I know that guy. I know that guy. I know it.
You know that guy? Dude,
that guy.
I love that guy. I love that guy. So basically, it'll be like people who have overgrown lawns because they have really fucked up, like situations. And he'll be like, I'll cut your grass for free. And he just records it. And I don't know why, but I catch myself spending hours on hours watching this guy cut people's grass.
And he makes so much business from these videos because people call him to cut their lawns, right?
Bro, I was watching the other day and I was like, man, how much do you think would one of these weed whackers cost? I think I could probably do this. Like I've got some free time during the daytime. Like I need to exercise a little bit. Maybe I'll get a leaf blower and I'll go just randomly blow people. But then I was like, wait a second, I live in a fucking affluent neighborhood. Yeah. I'll be like, the local dudes will probably end up coming and beating my ass. So.
All right, let me ask you this. Why did Meet Kevin say the recession is canceled? He was very bearish the past. If anyone watched the Meet Kevin videos over the past 2 weeks, he was hardcore. Recession is coming. Now he says no. He bought back Tesla. Do you think the flip-flop makes sense here, that these earnings justify not having a catastrophic crash?
To a degree. I think to a degree.
Do you think inflation can still fuck us?
No. Dude, have you been checking my posts on Twitter? I think this short burst of inflation that we have right now is complete garbage.
Really?
Oh, dude,
okay,
easily.
Why is it garbage? Let's see.
Let me present the data, because if I can present the data, that'll make it compelling. And then once it's compelling, then people can understand what it is.
Thank you everybody for being here. 787 people. Appreciate everybody. Hope everyone's making some good money on Microsoft or Google if you're in those portfolios or in those stocks. But even if you're not, this is really good for the market. And if Chris shows us some nice inflation data that's bullshit, then earnings should pump the entire market.
Okay, check this out. So this right here was something I posted on Twitter not too long ago, like about a couple of days ago. So if you see this line right here, the red line, The red line is shelter inflation. Okay, shelter inflation has been by far one of the biggest leaders of inflation so far. So because shelter inflation has been skyrocketing, so you can see here going up, up, and up, it kind of drags the entire inflation curve with it, right? So one of the reasons why we've seen this giant spike up is two reasons. Number one, you have the median price of homes starting to really go up after 2020, right? Why? Because a lot of people were using low interest loans to buy a lot of houses. That jacked up the price of homes, and the home prices started to climb higher and higher. Now what happened was, after that, normally when interest rates start to spike, usually you would see the price of homes come down significantly, because now the buyers, the people who are going to be buying, right? They have less incentive to buy. But what ended up happening was we actually supply locked ourselves. Now you have all these people sitting on 3% and below mortgages. They're not selling. Yet the number of people that want to buy, because the economy is so good, they're bidding for less inventory. Now the good thing is inventory is actually starting to come back to market again. Now at the same time, if you look at the data point for rent, that's what happened. The price of homes went up, so everyone started jacking up their rents as well. Now what you're seeing is that reversal. Rents are actually coming down in certain parts of the country. Remember, this is aggregate data, okay? If you live in a certain location that the rents are going higher, I'm sorry, that's just how it is. But if you look at the number of homes under construction, these are multifamily homes, the units, look at how many are currently under construction right now.
When do you think
Right?
this actually impacts shelter and CPI?
So that's the key, right? It's lag. And a lot of times people forget that. Look at the amount of lag it took for the data to show up. So if you look at green right here, this is the median sales price of the homes, right? But shelter inflation kept going up almost for another probably year and a half to 2 years. Now you can see that reversal trend go down, and it's actually going into the negative. So the median price of homes in the United States is actually negative now, negative growth. What does that mean? That means that some parts of the country, homes are actually cheaper today than they were in 2022. Okay.
Okay.
Now, is that a good thing? Yes, I think it's a good thing, because people are going to, be able to buy some homes. Problem is, interest rates are really high. So that means that the cost that you would have to pay on a monthly basis is actually more than what it was in 2022. The good thing is, if rates come down, right, more people are going to put their homes on the market, and as more homes come to market, you're going to see what is that thing called? A combination of two things happen. You're going to see, number one, inventory rise, which means the median price is going to stay down and keep going down to a certain degree. And at the same time, the cost that someone has to bear paying out is going to be less, because instead of getting a 7.5%, 8% mortgage on the median home, they're going to be able to get a 5% or even a 4%. So I think right now the key here is the Fed needs a little bit more of a push towards, better stability, and in terms of like the rates decline. The inflation's declining, especially in core. But today, especially with that GDP print coming lower than expected, it just gives the Fed more ammunition to say, hey, wait a second, we might actually be able to actually cut,
And oil's coming down as well, right?
Yeah, oil, now that the Middle East issue is starting to kind of like stabilize a little bit. Let's take a look at that real quick too, because I think that's important. Oil has been one of the biggest headaches in the short term.
Real quick,
because it does filter in.
Anonymous says he just found this channel. Very impressed. Anonymous, thank you for being here. If you are new to this channel, please consider subscribing. We do a market open show every morning and evening. All right, here we go.
So as we look here with the Brent prices right now, so let me just hold on. Go to trading Mac. Actually,
and then after this, we got to talk PCE tomorrow as well.
Yeah. Trading view, not trading view, macro. I'll have to post the DD later about this, but the point is, oil is starting to top out a little bit. The summer driving season is upon us, but you're not seeing a huge spike yet. I think the Middle Eastern countries right now, they are the only things that are keeping prices where they are. But even they realize that They cannot let oil prices get so high to the point where they're going to be causing worldwide turmoil in the markets, right? Because
Yeah.
at the end of the day, a lot of their money is also invested in the
Yeah, like
general
Iran
market as
doesn't
well.
Iran's not going to fuck with Israel that much because they know like their money's
Yeah.
from oil as well, right?
Right. So the thing is, the higher you raise oil, the more likely it is that you'll have American production start to climb as well. Now, American production right now is somewhat muted because if you look at the numbers, they've kind of like topped out a little bit, about 13 million barrels, but that is likely to change in the back half of 2024. So a lot of that production, as it comes to market, is going to keep a lid on oil price. And if it keeps a lid on oil prices, what happens is next year, if you look at it on a year-over-year basis, right, the oil price is going to be zero inflation. If it's zero inflation compared to last year, that's a really good thing, right?
Okay,
So
now tell me PCE. What is PCE for those that don't know? Why does the Fed care, and what are the worlds tomorrow if it goes too hot or too cold?
So PCE stands for personal consumption
Expenditure.
Expenditure, right? So it just means, let me just look up the actual definition because I don't want to get this wrong. Right here.
Paperhand says, can you explain the snow thesis? Me and Chris, Chris, on Saturday, I think we do the live podcast on snow because we've been promising it for a long time. So Saturday, Chris and I, probably like in the afternoon, we'll discuss everything about Snowflake.
Right here. So PCE, price index released each month, is the personal income and outlays report. Reflects changes in price of goods, services purchased by consumers in the United States. So basically, it's the price that people are willing to pay for things, right? And then how much does that end up impacting? Now there's something called core PCE, and then there's regular PCE. Core PCE is what the Fed actually uses as a benchmark to figure out.
Right. So today we got PCE that was 3.7 versus 3.4. So inflation went up. Not good.
Yeah.
But core comes in tomorrow. So everything you're saying about shelter and oil makes sense. If core comes in hot like regular PCE today, do you think we're still in some trouble?
I think that we would get an elongated rate cutting cycle. Well, like that just means that the Fed is less likely to cut sooner than what's currently projected out. Because remember, a lot of what that's moving the markets is actually expectations rather than reality, right? So if you're expecting things to go down, you're cutting back. If you're expecting things to go up, you're spending more, right? So I mean, well, it's actually the inverse in terms of inflation. What I mean is, right now, the expectations are set that we went from about 5 cuts this year to 3 cuts to now no cuts, and to some degree, some are even saying we might get a raise in Fed funds rate. I don't think we get a raise. I think that one is just too hyperbolic. I think maybe if I had to percentage it out, I'd say maybe 5% chance that there's a raise coming. But I don't think a cut is coming anytime until probably the end of this year. Now the question is, how do you project that into your scenario for 2024, right? So we're almost halfway, and it's kind of really like interesting. We're almost halfway through 2024, right? Because it's 425, so that's 5. So we're literally at near the halfway mark. So there's not a lot of room to go if you think about it. It's only 6 months away.
Yeah, that's true. So okay, so if PCE, if the core comes in hot tomorrow, do you think it just makes us take longer for the rate cut, but the rate cut still comes?
Yeah, I think the rate's still too.
Okay, now the thing is here, Google and Microsoft crushed. Amazon and Apple likely will crush if Google and Microsoft crush, and Meta crushed. They just had they increased some expenses. So can the market overlook higher inflation for the next 4 months if given these earnings? And can the market go higher, or do you think we stagnate?
Well, this is where you have to use, and you have to do the research for yourself on the ground to figure out, okay, if you're waiting on the Fed to basically spoon feed you data, you're already behind the 8 ball, right? If you're an investor, you're looking at things that the Fed is not covering right this second, and then making your assessments based on that. So for me right now, I'm looking at shelter, not from, hey, what is the Fed going to report this Friday? No, I'm looking at actual data. So I'm looking at Zillow's data. I'm looking at Rent.com's data. So let's take a look real quick what I mean by this. All right. So if you're waiting on the Fed to give you the data and you react to it, you're already behind the 8 ball. For me, I'm more into like, hey, let me actually see what's going on the ground, right? So let's do a quick exercise. So one of the things I like looking at is Rent.com. They have some really great data points, and they publish this every month. So what the Fed usually is putting out there is a little bit like backwards looking, because they're looking at, oh, what's going on, whereas I want to see, okay, what's actually happening on the ground in more latest terms. So if you see, hold on one second, the market reports. This is, by the way, this is
put in the chat what you're eating for dinner. I know that's random, but still, I'm always curious what people eat for dinner. So put in the chat.
So Rent.com has a lot of great articles on like what's going on with the actual data. So like there's certain markets that are just oversupplied. Like right now, oversupplied rental market behind Austin's dramatic rent swings. Austin right now is actually going through a rental reset where things are actually starting to go down. Let me just find they have like a great data page. Let me just put it up. Hold on one second.
One thing also for people, GDP expectations came in lower than expected. Inflation came in higher, which kind of got the market scared today as well on this idea of stagflation. I think Google and Microsoft are proving, no, growth is going to be there ahead of what GDP projects. And then if Chris is right that inflation does indeed come down, we probably aren't in stagflation.
So this right here is rental data, okay, from national average, and then you can see in certain regions, right? So the average rental price of a home pre-COVID was about $1,600 and $1,600, let's just say. Depending on which region, it could be higher. So in the Northeast is about $2,000. The Midwest is about $1,200. By the way, if you're a minimum wage worker, okay, and you literally are starting your life, stop trying to live here. Live over here. It just makes more sense to live in an area where you can actually afford. I know that some people will be like, no, but I really want to live in the Northeast. Don't turn yourself into a wage slave by literally paying someone's entire lifestyle while you're slaving away. Because at the end of the day, if you think about it, the amount of money extra that you make by living in the Northeast is not that much more than someone that's living in the Midwest. And Midwestern people, especially with minimum wage the way it is, you could get a $20 an hour job in the Midwest. Like, dude, the Waffle House near my house, they're making about $22 an hour right now at Waffle House. All right.
Yeah.
So you don't have to live in this area. And by the way, if you live here, that $22, about 18 of it's going to go to rent. Whereas if you lived here, more than likely, maybe like 20% will go to rent. You can use that additional savings to build your equity in your savings. And then this way, eventually, by the time you're in your whatever, however you are, you have some positive money saved up. But I'm digressing. I think this is something we'll talk about later. But one of the things that you're seeing is April of 2020 or April/August of 2022 is when we had what is that thing called? The peak, right? So you can see here the average rent had started to kind of trend down, and right now it's actually pretty flat. So since August of 2022, you're seeing nothing but flat rent all the way through. And it's not just the United States. I mean, like aggregate in general. There are other parts of the country where you're seeing this flatlining of rent. So I think this is very important because these data elements are going to be year-over-year changes that are going to keep showing up in inflation data going forward. So what's going to happen is shelter, because of the lagging nature of how it is with 1 year lag. So as an example, if you signed a lease here, right, in April of 2022, you're not going to move out until August of 2022. You're not going to be moving out until August of 2023, right? And if August 2023 it was $2,000, right? So that means flat year-over-year rental growth, right? If there is going to be a cut in rental prices for you, there's not going to show up right away. It's going to show up in August of 2024. So you can see here right now it's actually lower than what the price was. I think this trend is going to keep going sideways, and I think rentals are not going to be worth as much. I think shelter overall is going to be coming down, and we'll see what happens. We'll see what happens there. I do think that there are certain areas in, let's say, the Northeast where the prices have gone up, but that's primarily because of local policies that are, in my opinion, absolute asinine because they just won't let people build more homes.
Yeah.
The price of homes are going, or the rent prices are going higher and higher. Like in New York City, there's actually a ton of rentals right now that landlords are just not putting on the market because of some of the rent law changes that the city made.
Right.
So, it's one of those things that it's going to be very region specific, by the way.
So overall, inflation you think will come down, even if it's going to be a little bit of a battle. Google and Microsoft, no red flags that I'm seeing in their earnings at all, really. Oh, the dividend. What do you think about Google's dividend?
I'm not.
I mean, it doesn't matter, but it's good, right? It's still
No, it's good. I mean, it's definitely gonna. Someone on Twitter posted a meme about like, you ever seen Band of Brothers with all the soldiers kind of charging in? So you see like all these people charging in into Google because now there's like, oh, this is a dividend payer now. So it's gonna attract a certain higher, older, mature like segment of the population that lives on income rather than just capital appreciation. See, the funny thing is, if you think about it, the best way to play it would be you would buy the capital appreciator, and as you need money, you sell 1 or 2 shares or 3 shares, 5 shares, whatever. And the thing is, it's going to keep going higher and higher, right?
Yeah.
So I would say you want to buy, but the good thing is now you're getting a dividend and you're getting share buybacks. So the amount of cash these guys are generating is just astronomical,
All right, this is exciting. We'll be live at 9 p.m. So in about 2 hours on Finance Junkies. I'll just put the channel in the description, and we will keep the conversation going on from there.
Here's a really quick question, just between me and you, as we're just talking. What are your thoughts on Meta?
I think Meta's cheap. I think it's a good cut. I mean, it's a good discount. I don't see them going to like the 350s or anything like that. Just because the only thing I saw on the earnings call was they increased CapEx, but every company, Google increased CapEx, Microsoft increased CapEx, Apple's going to have to increase CapEx because they're all buying chips and AI infrastructure. So I think the market's going to get numb to that. And ultimately that's going to be good in the long term. And the guidance, it was a miss on guidance for revenue, but by Q3, that's when the political advertising should speed up. So I think this is a buy the dip on Meta, but it's not like an amazing risk to reward given it's already up 20% year to date.
By the way, a lot of people ask about the hat, like why I wear the hat. This is my lucky hat. I did not go to Carolina for undergrad. I actually went to Stony Brook in Long Island. My wife went to undergrad and graduate school in UGA. So this hat, she hates it. She absolutely fucking hates it. But that's probably why I wear it too, to gaslight her a little bit. But what happened is, ever since I bought this hat, I've done really well in the market. So now I'm a little bit superstitious with it. I'm like, so sometimes, like, you should have seen me. I freaked out the other day. I was like, "Where's my hat, dear? Where's my hat? Where'd my hat go?" So it's just my lucky hat, man. It's funny, it's red because ever since I got it, my portfolio has been nothing but green.
Yeah, I love it. I love it.
So yeah.
All right, good stuff. We'll be back at 9 p.m. We'll keep talking about everything going on. And yeah, congrats to anyone who owns Google or Microsoft. And in general, if you're in the market, it looks like the market should be okay. We'll see what happens. But these are the 2 biggest companies. They reported well, and we'll keep going with earnings season coming up.
Yep. Later.
Good stuff, guys. See you in a couple hours. Bye, everyone. Good night.